It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance Live. Here's what we're watching this morning. Well, the top story, the Fed's favorite inflation gauge coming in line with expectations, growth cooling to 3.5% year over year. It's a welcome sign for investors and the Fed, although still a ways away from the central bank's 2% target.
Plus, a fiery interview with Elon Musk, the billionaire lashing out at advertisers who had left X over anti-Semitic content. Musk's recent string of controversies frustrating investors far beyond just X, and it comes as Tesla Cybertruck deliveries are slated to start later today.
And a seat at the table for Microsoft. OpenAI is the largest single investor, snagging a non-voting observer role on the company's board. The position coming with Sam Altman back as CEO of OpenAI.
We turn our attention to the top story of the day here, the Fed's favorite inflation gauge, PCE, also known as the Personal Consumption Expenditures Price Index, that showed further signs of cooling in October. And core PCE, which excludes the volatile food and energy categories, grew 3.5%. That's down from 3.7% from the month prior, and in line with what economists surveyed by Bloomberg had expected. We're still a ways away from the Fed's 2% target, but it's certainly a welcome sign that inflation is coming down here. And there you're taking a look at some of the actuals versus the estimates that came in here. And I think what the Fed is looking for continuously, even more so than that 2% target, is some of the stickier areas of inflation, particularly some of those higher costs. And you typically look at some of the other prints that we've gotten most recently, where shelter continues to be one of the largest contributors to that. But I think that's where the Fed is going to be looking for any cracks in inflation to continue to move forward here, especially as some of those stickier areas in services have been at the top of the mind for the Fed too.
Yeah, certainly. We're expecting to see some softening in this report, and we did get just that. This reading of 3.5% for core PCE. It's the lowest that we've seen in just about 2.5 years, going back to April of 2021. And putting this in perspective with Fed policy as well, the Fed funds rate now at 1.8% above a core PCE, making this the most restrictive policy that we have seen since 2007. So, of course, where we are in this race, or where the Fed is in their attempts to ease inflation, of course, is the big discussion point amongst policymakers, also amongst investors as well. And we have had differing views just this week on the fight with inflation and where things stand. And even most recently, just in the last 24 hours, you have Bostic coming out saying that he is increasingly convinced that we are on this downward trend here for inflation. And then taking the almost essentially the opposite side, we have Barkin coming out saying that he doesn't essentially see that being the case, or it's too early to call just yet. And I mentioned those two comments because both of those Bostic and Barkin are both voting members for the Fed next year in terms of policy and what we could see. So, of course, this then begs the question that the street was getting very optimistic. I think they would put it that way, just in terms of what the timing would look like on a cut. We had Ackman earlier this week saying that, hey, we could see the Fed cut in the first quarter. But we got to remember that core PCE obviously still 1.5% above where the Fed's target is.
Well, kicking in the screen door over at the Ackman residence, thinking that there's going to be a cut, is Mary Daly this morning. Mary Daly saying, I'm not thinking about rate cuts at all right now. We're going to get a ton of Fed speak over the course of today to really kind of round out the week. But this coming off of that fresh economic data that we were just discussing here. But I think that most notably is where some of the Fed members, voting and even non-voting, and as we get some of that Fed speak that continues to come forward, pay close attention to those voting members and what they're saying, especially going into a time where you've got some of the most bullish calls on Wall Street that are hinging on some type of cut coming forth either in the first half of 2024, and some of the others that are just looking for one to come forward at any point in 2024. But a pause doesn't necessarily mean a cut at this point.
Yeah, certainly. And as we can see from the commentary that we're getting out this morning, and also what we've seen over the last several weeks, policymakers still remain split just in terms of how much progress they have made for their fight to tame inflation. All right, another big story that we're watching is Elon Musk having some choice words for advertisers who are boycotting his platform X. During an interview at the New York Times Deal Book Summit, Musk hit back at brands pulling advertisements from X after he responded to an anti-Semitic tweet earlier this month. Now, he seemed to take aim at one person in particular, and he certainly did, calling him out by name. Now, earlier in the conference, Bob Iger did say, quote, "The association with X is not necessarily a positive one for us." And these are just the latest comments. We've talked a couple of times here over the last week or so, just in terms of brands leaving X, not feeling comfortable, no longer feeling comfortable advertising on the platform following the latest post that we have seen from Elon Musk. Of course, Elon Musk has tried to walk back the post numerous times. He also did that during the interview yesterday. But I think that Musk is solely to blame here in terms of what is happening with advertisers, the boycott that we have seen. This is not the first boycott, obviously, just in terms of the words that he has chosen to associate himself with certain causes, and companies simply are not comfortable with that. We have IBM, Apple, Disney with Bob Iger, just to name a few. We have a couple more logos up there on your screen just in terms of brands who no longer want to be associated with X right now. And I think the big question is, what can Linda Yaccarino, the new CEO of X, do right now? Her hands seem essentially tied just in terms of her ability to go out there with the message that brands should want to be associated with X at a time like this.
You're spot on. And at the end of the day, I would be upset too if purchase that I made for $44 billion that now reportedly as of a month ago, because of some of the kind of stock grants or options that they were making to employees, was discovered to be worth somewhere around $19 billion here. So you've lost over half of the valuation of that, if it was even worth that to begin with. You overpaid on that. Number two, you've got advertisers that are fleeing because they can't annex their brand to a platform who has a leader that goes against their core values at the end of the day. Now, their political contributions are perhaps totally different on that, at least they would like to say. But at the end of the day, for Apple and what they've seen for Disney, he had just thanked them earlier this year for remaining two of the largest advertisers by dollars spent on the platform, saying that at the Morgan Stanley Technology, Media, and Telecom Conference in San Francisco, and the company acknowledging that. So all in, you're going into a time of, and already amid a time of year where advertising among some of the largest consumer electronics companies, that's key for X to continue to see that revenue realized in this period of time, knowing that there's going to be major promotions, there's going to be major sell-through of inventory that electronics, footwear, apparel, retailers, all of them are trying to move through, and they still need to make sure that that message gets out and see some type of return on investment and click-through ROI for all of those who are still engaging in one form or another on X. Now, there's a totally different company that perhaps Tesla or Elon should be annexing most of his energy to, and that's Tesla. Why? It's a big day for Tesla. Tesla launching deliveries of its much anticipated Cybertruck today. This is going to be Tesla's first brand new vehicle model in over 3 years, and says hundreds of thousands of people have already placed $100 refundable deposits on the car. That's nothing compared to what it's expected to cost here. We've heard somewhere in the range of upwards of $50,000, but perhaps even $60,000 to $70,000 here. And the larger question to me continues to be, what would be that breaking point right now for some of the people who have already placed deposits to say, you know what, I don't want to take delivery of this?
Yeah, and I think that that's exactly right. And analysts right now have been asking who is going to buy this Cybertruck. You mentioned the fact that they have been talking about the hype, so many people interested, putting down $100 down payments, but like you just said, they're refundable.
Drop in the bucket.
In terms, it's no indication in terms of how many of those people are actually going to follow through and purchase those vehicles. And this comes at a time that the Cybertruck has been delayed for years. We first started talking about it years ago, 3 years late to the market. When it comes to exactly who is going to buy it and the success of this vehicle, Musk also weighed in on this during the Deal Book Summit yesterday, saying that it's going to be the biggest product launch of anything by far on earth this year. We know he loves to hype his own products. How successful this is going to be for Tesla, obviously, is a big question. This stock has done very, very well over the last month or so. You're looking at a year-to-date chart, obviously up nearly 100%. Even in the last month, just this month of November, you're looking at share gains of 22%. So whether or not the Cybertruck is able to live up to the hype and how big of a boost or how big of a generator this is going to be in terms of bottom line, that is the big question when you talk about the cost of it, because it has certainly been a challenge for Tesla even to bring the Cybertruck to the market.
I mean, look, it's a Pentagon trapezoid on wheels, essentially. And at the end of the day,
some people like it, though.
Some people like the rugged nature of
We were
it.
just talking to Greg Migliore yesterday of Autoblog, and he was saying that he actually thinks it's a very attractive looking vehicle.
That thing is going to stick out like a sore thumb coming down the street at you. If you're thinking about walking your dog and you see one of these cross by, you're thinking, man, I need to get a bigger dog probably at the end of the day. But it's a larger question for the people that they're looking to sell this into, what the haul is going to look like, how long can it go for on a single charge, because that is still the larger question, especially for vehicles of this size, to be proven to make sure that you've got that one charge that you can continue to rely on throughout the day. And I think that network continues to be in the larger kind of EV demand environment, the larger kind of talking point or sticking point for a lot of people that are even thinking about spending this much money on an electric vehicle.
Yeah, we're going to be talking about this later on in the show. We're going to be hearing from David Underkoffler. He's the editor-in-chief at Autolist, and they actually ran a survey just in terms of who is most likely to buy the Cybertruck. So we'll see. We're going to break it down by generation. All right, let's stick with the automotive space and talk about Ford, because new headlines out this morning. They're out with their full-year guidance after previously pulling it amid the strike with the UAW. Now, the automaker is expecting adjusted EBIT of $10 billion to $10.5 billion and adjusted free cash flow of between $5 billion and $5.5 billion. And when you take a look at these numbers, of course, these headlines from Ford following what we heard from GM's Mary Barra yesterday. She was on with Yahoo Finance. But when it comes to this cost and exactly what the UAW strike, the cost of it to Ford, and exactly what this new deal means for Ford going forward, labor costs are going to rise by $8.8 billion over the duration of this new contract, which is just under 5 years, and it's going to cost about $900 per vehicle. And Ford, a CFO in an interview, saying that he's aiming now to reduce labor hours per vehicle. They're doing all they can to boost their margins on EVs, and we know that that has really been a sticking point for these automakers. They're trying to figure out how to make these vehicles cost effective. They want to lower the price so they're able to boost adoption, but obviously they also need to make money on them, too.
Yeah, absolutely. And this is what the street was waiting for. Any more inclination that Ford could provide some details around how they've already been impacted and how they're kind of doing the calculus on a per vehicle or unit cost going forward here, and then what's already taken place. $1.7 billion in strike-related lost profits is what they know, to about $1.6 billion of that in the fourth quarter, owing to interruptions in production of high-margin trucks and SUV, and in turn, vehicle wholesales about 100,000 units lower than planned here. And so you're taking a look at shares here pre-market. They're up by about 0.9% here. And I think what we're going to hear more from Lawler here on the day actually comes forward in a statement that they made with this release, saying Ford Plus is the right strategy to win. Highly talented team, allocates capital, great discipline. And discipline is going to be one of the words that we hear even going into the start of 2024. We had talked to Liz Young from SoFi about that. One of the themes that she was expecting over the course of this earnings season, cost discipline. We've heard that in many different forms or another. Lawler re-indicating that again today and coming off of the decisions that they've had to make, making sure that they've got enough people to power this vision forward and coming off of the UAW strikes that took place.
And it's also going to be important to watch how their plans, the plans that they had already laid out for EV production going forward, if they continue to change, because we have had a number of headlines, Ford being one of those who are scaling back their plans for a $3.5 billion Michigan battery plant. They announced that earlier this month because of the disappointing demand that we're seeing for EVs. So, of course, this is the question here across the board for automakers, how to boost that demand and do it in a cost-effective way.
Absolutely.
All right. Discipline.
Yeah, 100% here. Well, let's talk a little bit about investors who are tracking Salesforce on the day. Ticker symbol CRM on the move after the company saw revenue climb 11% from last year, raised its 2024 guidance for operating cash flow growth. And this comes after it implemented a restructuring plan that involved laying off 10% of its workforce. That was earlier this year. What you should know happening here and now, as Luther Vandross would say, multiple firms coming out this morning and upgrading or at least their price target. And in two cases, you got new buy ratings coming in from JP Morgan and RBC there. But JMP, they upgraded their price target on Salesforce, 293. Morgan Stanley sitting at 290 now. Barclays adjusting to 300. So all of this considered, lots of fanfare coming off of this quarter where ultimately they had issued some new fourth quarter revenue guidance of about $9.18 billion to $9.23 billion. That's up by about 10% year over year. And then they also narrowed their full year revenue guidance for fiscal 2024. That range now going to be $34.75 billion to $34.8 billion. That's up by about 11% year over year as well.
Yeah, Brad, you mentioned the street reaction, and you mentioned that Morgan Stanley raised its price target on the stock, and the commentary there from the analyst stuck out to me. Keith Weiss basically saying that yes, this is impressive when it comes with the 3Q beat, which is really across the board almost much better than feared fourth quarter forecast. But there are still questions just about 2025 when it comes to generative AI, when it comes to the position of Salesforce among a relatively crowded market, or one I should say that's dominated by a few very powerful names. That is a question for investors just in terms of what that upside looks like. And this is a stock that has done extremely well since the start of the year. We're looking at gains of just about 70%, the top performer within the Dow. So yes, their cost-cutting efforts are working. We know that Salesforce has essentially shifted their strategy. It's a company that has heavily relied on M&A activity to grow. They disbanded their M&A team when we talk about some of those restructuring efforts, the layoffs that happened earlier this year. So what's going to drive that growth going forward? I know Sazi has been covering this very closely. There has been a huge focal point on AI, but again, how big of a player they are and how much they can really make a dent in that space, I think they still need to prove.
Yeah, Sazi was at the AI day that Salesforce had earlier this year. I was watching online from my desk in my hoodie in the comfort of that. But one of the things that really jumped out to me at that AI day, because this is an AI story that continues to move forward for Salesforce.com, one of the things that you're going to continue to hear from Salesforce, Microsoft, is how they can make sure that within all of the applications that they put into workforce and into not just the sales teams, not the marketing teams, but overall corporate wide, it's going to be about the co-pilot, and it's going to be about the ability for anybody who touches these applications to run prompts, run them at scale, run them very efficiently, and then be able to fine tune exactly what the output is in order to have that much more quickly, a quicker of a customer relationship, put together a marketing automation campaign even, and then tracking of that digital body language all the way through to a potential sale. Or just knowing more granular data on your customers too. And so all that considered, I was kind of blown away by that AI day that took place earlier. I think they did a good job of communicating to the street where that incremental revenue is going to come forward and on a margin basis, how that should trickle through.
Yeah, exactly, because we know revenue growth was up 11% in the latest quarter, in line with expectations, but it was amongst the slowest growth numbers that we have seen for sales on record here for Salesforce. So exactly what that catalyst is going to be, we'll see how big of a dent AI proves to be.
Yeah, 52-week high they're going to be hitting at the open most likely.
All right, we're going to take a quick break, but keep it right here on Yahoo Finance. We've got all your market action ahead. We'll be right back.
Let's get you the market commentary of the day. Wall Street has been in a bullish mood, but JP Morgan breaking with the pack here for a gloomier forecast that they've put forward. Strategists at JPM expect the index to fall about 8% from current levels, ending 2024 at 4,200. Here to help us break down the reasoning behind this call, we've got our very own Madison Mills. Hey, Maddie.
Hey, Brad. So looking at JP Morgan here, the biggest bears apparently heading into 2024 here with more of a pessimistic view. And they really look at two big buckets here, market performance and business performance. So starting with the market side, they obviously talk about that concentration in the Magnificent Seven. They say that we haven't seen this much concentration since the 1970s. And typically when you see that narrow of breadth, you do see a slowdown coming in after that. Now, a lot of other firms on the street are saying that we're going to see this run up in small caps, that we're going to see earnings breaking through heading into 2024. JPM, not so much agreeing with that. On the company side, and we also just perhaps got more evidence of this when we got that CPI print, JPM noting that companies that had strong pricing power are starting to run out of steam as consumers are expecting a little bit more disinflation. So all of that leads to this headline quote that I want to pull up from the JP Morgan note here, saying that absent rapid Fed easing, we expect a more challenging macro backdrop for stocks next year, with softening consumer trends at a time when investor positioning and sentiment have mostly reversed. They also mentioned that equities are just overvalued. We've got volatility and, of course, geopolitical and domestic political risks as well. So all of that leading to a negative view.
Maddie, this is a pretty negative call, a bearish call, especially when you compare it to some of the other more bullish takes, like you briefly mentioned there, across the street. Even it's more bearish than what we heard from Morgan Stanley's Mike Wilson, who is a renowned bear and has been almost a perma bear now for quite some time. When it comes to earnings growth, how does JP Morgan stack up in terms of their expectations? And then more broadly speaking, how much lower is their expectation for the S&P versus some of the other calls that we've seen over the last couple of weeks?
It's so smart of you to mention Mike Wilson, because that's what stuck out to me, is that his target is 4,500, but even JPM is coming in at 4,200, which is obviously lower than what we're at right now. So definitely a more bearish view there for that 2024 outlook. Comparing to Wilson too, he projected that earnings would continue to rebound next year, with earnings per share popping by 7% from this year. JPM, not so much. They're saying maybe we'll see about a 3% number there when it comes to EPS. But again, doubting that companies are going to have that pricing power that they've had over the past couple of years due to this rate hike cycle.
All right, Maddie, thanks so much.
Thank you.
Well, on the back of the most highly watched data point this week, we're getting some reaction to how the Federal Reserve could attack its monetary policy playbook from New York Fed President John Williams. Now, Yahoo Finance's Jen Schomburger has the latest there. Hey, Jen.
Hey, Shauna. New York Fed President John Williams just beginning to speak right now in New York on the back of that PCE number, saying that while the decline in inflation is welcome, inflation remains too high, and that, quote, the Fed's job is nearly not done. In a speech right now, Williams saying, quote, his assessment is that we are at or near the peak level on the target range of the Fed funds rate. He says, based on model estimates, the stance of monetary policy is quite restrictive. In fact, the most restrictive it's been in 25 years. And to those on Wall Street who are pricing in rate cuts as soon as March or May of next year, Williams had this to say. He says, I expect it will be appropriate to maintain a restrictive stance for quite some time to fully restore balance and bring inflation back to 2%. Williams also added the caveat that if price pressures and imbalances persist more than expected, additional policy firming may be needed, so keeping insurance there on the table for potential more rate hikes. However, he does expect inflation to continue falling. He expects inflation to end the year around 3%, which is where we are right now. And then he sees inflation continuing to drop next year to 2.25% before closing in on that 2% goal in 2025. Of course, his comments coming on the back of a fresh reading on the Fed's preferred inflation gauge, the core personal consumption price expenditures index, which continue to show progress. But as Williams' comments underscore, while the Fed is encouraged by this, they're not ready to declare victory yet. They need to see more months of data, more progress before they will probably take those potential rate hikes off the table and say, we're going to hold steady here. Guys?
Yeah, there's a lot to continue to break down here on this. You know, Jennifer, while we have you, we're still continuing to get some of that Fed speak out, both from Daly, from Williams. I mean, as you've been mentioning, Williams seeing forecasts up and downside risks for inflation, and also saying that inflation will close in on 2% in 2025. There's a lot of time between now and 2025. Right. So are we just perpetually in the camp of trying to figure out if there's going to be a soft landing between now and then?
I mean, it really depends, right, how the economic data play out. We are seeing a gentle cooling here. We are seeing inflation gradually moving lower. If productivity is indeed surprising to the upside, then we can get that soft landing. But I think that those on Wall Street who are pricing in rate cuts as soon as March or May of next year are very premature at this point. The Fed is content to hold at heightened levels, probably where we are right now, through the balance of next year to make sure that inflation is back down to 2%. They don't want any head fakes. They don't want to repeat what happened in the 1970s, where you saw a U-turn on inflation. Now, whether or not we can get that soft landing and as a hold at that level, of course, remains to be seen.
Jen, it's Maddie here. Just following up on some of the notes that I'm seeing hit my inbox from banks this morning. Bank of America with a headline, the path to 2% is on track. Another headline saying cloudy with a chance of landing. And certainly Twitter this morning declaring the Fed's fight against inflation done. What more evidence is the Fed going to be looking for? If you had to pick one single data point, what are they looking for to confirm what the street and what Twitter is already saying here?
So I think they're going to need to see more continued evidence, right? We heard from Fed Governor Waller just this week saying that if we have a couple more months of continued slowing inflation, both measured by PCE and CPI, they will feel encouraged, or he will feel encouraged, that the Fed can continue holding at these levels. If we peel the onion, as Fed Chair, New York Fed President Williams likes to say, and we look at the housing piece of this, that is going to need to come down further, and Fed experts, Fed officials rather, do expect that to continue coming down. So they do expect a downward trajectory. They just need the data to confirm that. Again, they don't want any head fakes here.
Jennifer Schomburger and Madison Mills, thanks so much for joining us here this morning. Really setting up today's trading activity and what investors are going to be watching for here as well. We appreciate it. Thanks. Well, we've got the opening bell coming up on Wall Street. We're just about 90 seconds away from that. Let's do a quick check of the markets. Jared, one way to wordsmith together quick and markets is quick it. So, Jared, let me quick it and toss things on over to you.
I don't know how to follow that, Brad. I'll try. Energy pre-market here, just a minute to go until the bell. That is up about 99 basis points, almost 1%. You can see it was down about 0.75% yesterday. Industrials, financials, healthcare also popping this morning. Even tech filling out the front line here, the top line. And then taking a look at the Nasdaq. And by the way, I'm going to be doing a deep dive on the month's price action in everything we're seeing here in an hour, so stay tuned for that. But Apple up another 0.25%, Alphabet just barely in the green, Amazon down 1%. I was noting that energy is the best performing sector this morning, and we're seeing that in our heat map here. A lot of the background red, well, actually all of that is from yesterday. If you see green in the background, that's from yesterday too. But these little boxes here, BP, for instance, is up 1.61%. So we're seeing most of these issues pretty green this morning. And ARK, guess what? ARK is up something like 25-30% this month. A lot of these issues have just been flying. Today we're seeing Tesla up another 0.4%, Elon Musk in the news, and I'll just leave it at that. Zoom up about 0.5%, and there is the open on Wall Street. So let's just take a look at our sector board. And indeed, energy is still the #1 sector this morning, by far and away the strongest. Tech has now slid into the second place, and industrials up about 1/3 or 0.25%. And just want to show you what the bond market is doing. A lot of the risk on movement this month has been catalyzed by this huge downdraft in yields that has taken a lot of pressure off of risk markets. And we're seeing a little bit of a bounce back here today, 4 basis points, but not enough apparently to impinge on equity performance. And let's take a look at the 4-day view of the Dow. We can see we're up about 0.2%. The Nasdaq, that is up just 10 basis points, barely in the green there. And the S&P 500, we'll see if we can get that up. That is up, down actually about 5 basis points, but just about break even there. So as we close out the month of November, I'll send it back to you guys.
All right, Jared, thanks so much. Let's talk a little bit more about the rally that we have seen because, like you just said, it is the last trading day of a big November for stocks. Equities on track for the best month that we've seen in more than a year. We got the latest reading on inflation, core PCE or PCE coming in line with expectations. The core number cooling compared to what we saw about a year ago of 3.5%. We want to bring in our next guest to talk a little bit more about this. We have Christina Hooper, Invesco Chief Global Market Strategist. Christina, it's good to see you here. So when you take into account what we just saw with this core PCE number ahead of the bell this morning and pair that with the rally, the excitement that we've seen over the last several weeks, do you think the market has gotten a little bit too excited in terms of pricing in a rate cut in May?
Well, I certainly think the market is excited, but I don't disagree that about the price cut. I think we're likely to see that, very likely to see that, even though the Fed is telling us, or most members of the Fed are telling us otherwise. They're incentivized to talk down markets because they don't want financial conditions to ease too much. So I think it's very understandable that we're getting this language. We probably will see some movement down in markets, some tamping down in markets. But the reality is that inflation is coming down. We are on the D train, and D means disinflation. And we are headed for, in my opinion, the start of rate cuts in the spring.
Okay, if we did see rate cuts in the spring, and I will say, we certainly do value these conversations a lot. We've just had Mary Daly coming out this morning saying that that's not on the table for them right now. Where and what data would the Fed have to look at and say it's so grim that we can't help but to cut rates?
I think that's an important question to ask. And I would argue that you don't have to have grim data in order to see rate cuts. In fact, Chris Waller, in his comments the other day, said that all we need to see is continued improvement in the inflation picture, and that would actually trigger rate cuts. And I believe him. I think we don't have to see any kind of significant deterioration in economic data. In fact, what we know is that the lagged effects of monetary policy are long and variable. It could very well take some time for bad news to show up in the economic data. So I have no problem with the Fed being proactive and reacting. Keep in mind, we just heard this morning that Fed policy is very restrictive. So to have some kind of cuts in the spring, once the Fed is well on its way to achieving its goal, makes sense.
Christina, if in fact the Fed does end up cutting like you expect in the first half of next year, how big of a catalyst is that going to be for equities next year?
Well, interestingly, if we go back and look at the last 6 rate hike cycles and the aftermath, we saw rallies start when the tightening cycle ended. We actually don't need cuts to have a strong rally because the market discounts in advance what it expects to see in the future. And so what I think is going to happen is a situation where we see a strong rally now, growing global risk appetite, and we're likely to see some moderation in returns as we actually get those rate cuts, the start of rate cuts. I think that will be the start of perhaps a less positive market environment. It will still be positive, but I think what we're seeing now is going to be a pretty significant level of risk appetite growing.
Christina, just lastly, take us into your strategy scope here. When you think about rate cuts, what is the top idea that investors perhaps should be considering or imploring if we were to see rate cuts initiate next year?
So that means that if we see rate cuts start next year, the market is discounting an economic recovery in the back half of 24, in my opinion. So what we're likely to see is small caps perform well, cyclicals, but my strongest conviction would be around emerging markets because historically they've benefited from the recovery trade. They've been a very significant beneficiary. So if all plays out as my base case suggests, I think emerging markets equities will be a significant winner.
All right, Christina, always a pleasure to get some of your insights and analysis. Really appreciate kicking off the conversation here in the trading session with us here on the day. Christina Hooper, great to get your insights. Invesco Chief Global Market Strategist joining us here this morning. Thanks.
Thank you.
Absolutely. We got to talk a little Kroger here on the day. Let's go to the grocery aisle, slashing its full-year guidance this morning as it offers a dimmer outlook on same-store sales growth. The company blaming near-term economic pressures and food-at-home disinflation pressures for its third quarter. The top Wall Street expectations, even though shares right now, you're seeing them lower by about 1.25% as of this point in time here for shares of KR.
Yeah, Brad, when it comes to obviously this brand very exposed and heavily reliant and very reliant on consumer spending, and we have seen consumers pull back on spending. So when you mentioned that guidance number, the fact that forecast a bit disappointing here for the street, they did mention the fact that they are seeing some pressure on the consumer. They saw it reflected in this most recent results, and they do expect that to continue to weigh on their results here in the coming quarters. They did, though, have gross margin of 22%. And they also did say, though, that despite the fact that they did cut their sales outlook, there is a lot to be optimistic about going forward. We know that this is a company that also tends to outperform as customers do trade down. The private label has been a huge boon for them. I think the big question, which is the overhang on Kroger, is the deal with Albertsons, whether or not that's going to get approved and exactly what that timeline looks like, because here we are still without a decision, and it's something that I think most likely came up on the earnings call. If not, it's one of the top questions that analysts have then looking ahead to 2024.
Yeah, the company talking about that consumer tightening and the spending of the tightening most recently, saying that they're focused on, of course, some of those long-term initiatives that they've communicated to the street to this point in time, and going to be leaning into price mechanisms wherever they may, personalization and promotion, specific promotionalization, and then rewards too. This is a time where if you see any type of weakness in consumer spending, that's where grocery chains specifically are going to be looking to lean into the reward statuses that they do have with members. However, they're going to have to make sure that at the same time, and they acknowledge this within the quarter too, investing in wages, benefits, and training, those are some significant investments that are going to impact the overhead or the operating expenses at least here. And so in this current economic environment, that's where they're going to be, I think, communicating a little bit more to the street around the strength in their model right now.
Yeah, certainly what separates them amongst the others and what is a very competitive space. All right, let's take a look at two other names that are trending this morning. Jefferies upgrading both Pinterest and Snap to buy. The firm raising Snap's price target to $16 a share, saying that U.S. revenue growth, they're confident that it's going to reaccelerate next year. Pinterest, the company raising its price target on that stock to $41 a share. Jefferies making the argument that they are optimistic about Pinterest's ability to grow revenue next year. So pretty similar argument. Now, it is important to point out that Jefferies did note that there is some risk in a macro slowdown that has weighed on ad budgets for both companies. Now, price target for Snap is the highest on the street, the second highest for Pinterest. We talk about ad spend, clearly a big driver of both of these stocks in terms of revenue, what exactly they are going to see. Jefferies, at least right now, pretty confident in the position of both Snap and Pinterest at this point. Now, it's a bit of a contrarian call on Snap because it's not too often that you have someone coming out saying, this is a buy and this is why. And this is why I had the highest target on the street, because Snap is a company that has struggled for some time. They've been under pressure. They need to be a little bit more innovative with their product. They need to do more to court and really boost their user growth. They haven't really done much of either yet. Jefferies making the case that they're confident that revenue is going to rise next year. And I think a lot of that is just surrounding what they hope to see or what they anticipate is going to be a better ad market environment.
Yeah, maybe this is more of just a call that says, hey, all the spooky ghosts are behind this company right now. And so going forward here, if you've got the worst of the environments that is in the rearview mirror for the company, especially on Snap, then perhaps there's a reason to be a little bit more optimistic going forward. They talked about the underperformance in Snap. snap. Jeffrey saying that it's largely kind of due to this direct response advertising platform rebuild that they had to initiate. You also got to think about where they're going to in an advertising environment that's going to be continuing to look for a best return on investment and more shoppability. If you look across any social media company right now, what's the core functionality that all of them have been investing into? It's been trying to make it into a mall type experience where it is more shoppable. You've got more time spent on the platform. The influencers are just pouring money in, but that money is essentially coming from some of the influencer marketing budgets that some of the largest companies have to deploy at that point too. So all of that considered, more time spent, perhaps more click-through, more revenue, and more effectiveness on those campaigns. That's what all of them want to advertise on when they go out to the advertisers who are actually running these campaigns and spending millions, if not billions, of dollars on the platform too. So the analysts really looking to see where Snap is well positioned and looking for 15% revenue growth in fiscal 2024 on the back of all this.
We'll see whether or not we get it. All right, let's talk about another big story that we have been following very closely here at Yahoo Finance, and it's America's obsession with weight loss and diabetes drugs. It's certainly tipped the scales this year for Wall Street. Now, pharma companies like Novo Nordisk and Eli Lilly are cashing in on these newer drugs in a class known as GLP-1s, and it could have big implications for other sectors. There's a new note out from Stifel breaking down the potential ripple effects of these weight loss drugs and what stocks are going to be winners and which could be losers as a result. We want to bring in one of the analysts behind that note, Jim Duffy of Stifel. Jim, it's great to see you here. So before we dive into the winners and losers, I'm curious to get your perspective on the U.S. consumer survey that you did conduct. It was all on use or planned use. What did you find? Because I think that's a big question mark right now in terms of what the impact is going to be, is just what the uptake rate is going to look like.
Yeah, well, first, thank you for having me on the show again. This is a proprietary Stifel survey of consumers. What the survey found was that 15% of consumers are currently engaged with the drug, 9% of those for diabetes purposes, the other 6% presumably for weight loss purposes. Perhaps more interesting was that 21% of consumers indicate that they would be interested in partaking with the drug should it become more widely available, FDA approved, and affordable. Looking within that additional 21% of consumers, it skews more affluent and skews more female.
Okay, and so that affordability factor too, because that can play a big role in if they're purchasing more of these GLP-1s, what are they purchasing less of perhaps? And so was there a kind of a sweet spot that the survey really uncovered here?
Well, I don't know that we necessarily balanced the share of wallet, but we do expect that there will be less calories consumed. The projections of our food and beverage team get to 4% less calories consumed with this adoption. And we do think that there's going to be more apparel spend. Consumers are losing significant amount of weight on these drugs. Some clinical trials, including one released recently from Mongiorno, speaks to greater than 40% of consumers losing more than 10% of their body weight. And so we think those consumers are going to need new clothes. And so we do think this is going to be beneficial for category spend in the apparel space, specifically for names like Lululemon, Contour Brands, which owns the Lee and Wrangler brands, and then Levi's.
Jim, how much is it going to move the needle in terms of the impact that it's going to have? Yes, they're positioned to benefit, but I guess when you drill down to the numbers, what does that then look like?
Yeah, here's the math that we went through. If you take that 21% of consumers, assume that half of them engage with a GLP-1 variant, half of them stick with it for a year, and 40% of them lose upwards of 10% of their body weight, that's about 2% of consumers. And we think that consumer is going to need to upgrade their wardrobe and would spend double the amount of apparel on an annual basis. And so we think it can be a low to mid-single digit benefit to overall apparel category spend, concentrated with certain brands, particularly those that have a concentration in bottoms. I mentioned Lululemon. Lululemon has a very strong bottoms business. There are other dimensions of where we think they could be a beneficiary. Exercise increases the efficacy of these drugs, and so we do think you'll see some increased participation. Then, of course, if you're losing weight and feeling good, you may want to dress a little sportier, and so we think Lululemon could be a beneficiary there as well.
I mean, I feel great when I'm just taking down a massive burger at the end of a workout because I feel like I've worked for it, Jim. But that appetite is not there at the same cadence when you're on some of these weight loss drugs. And so at the end of the day, what other lifestyle changes could significantly impact perhaps some people's portfolio plays as they're trying to monitor where the consumer cohort that's gravitating towards some of the weight loss drugs out there, for better or worse, is also changing their own lifestyle too?
Yeah, it's a very interesting question. This was a collaborative effort of a number of different Stifel analysts. One area where we think we could see benefit to consumption is energy drinks. Less calories consumed means less energy for consumers to burn. And our studies suggest that consumers are leaning on additional caffeine and additional energy drinks to help them with those energy levels.
Wow. All right. We're taking a look at some of those energy drink manufacturers here on the screen right now. Jim, great insights here, and thanks so much for bringing it to our attention. Jim Duffy, Stifel analyst. Appreciate it.
Thank you for having me on the show.
Certainly. All your markets action ahead, everyone. Stay tuned. You're watching Yahoo Finance.
Former Secretary of State Henry Kissinger has died at the age of 100 years old. Now, the longtime diplomat leaving behind a complicated legacy, drawing both praise and criticism for his foreign policy actions and diplomatic achievements. Chief among them, his progress in U.S.-China relations. Now, Kissinger helped organize President Nixon's historic trip to China in 1972. He would go on to advocate for continued engagement and closer ties between the two countries. His last visit to Beijing was in July. Now, China's ambassador to the U.S. called Kissinger a, quote, valued old friend to the country. Joining us now to discuss more about the complex legacy that Henry Kissinger leaves behind, we want to bring in Ambassador Mark Ginsburg. He's a former White House Middle East advisor and also former ambassador to Morocco. Ambassador, it's great to see you here this morning. And thank you so much for making the time to join us, because I know that you knew Secretary Kissinger personally, and I'm curious just to get your perspective on the influence that he had and also how he has really helped, or how he helped shape foreign policy to this day.
Well, I had the privilege of knowing Dr. Kissinger not very well at all, but really in terms of deep time together. I traveled with him to the funeral of Prime Minister Golda Meir of Israel. Of course, there he was considered to be, during the time of the 73 Yom Kippur War, a great hero of Israel, because he and Golda Meir were able to establish a commitment by the United States to help rearm Israel at a time when it was surprisingly attacked, just like President Biden is doing today with Israel as a result of the October 7th attack. But I also spent time with him when I established the Arab language television production company after 9/11, that he and President George H.W. Bush encouraged me to help create. And he was an enormous backer of that effort, and I'm always grateful for his support. But during the time that I traveled with him for those 15 hours to Israel, I also spoke to him about the legacy of his role in perpetuating the war in Vietnam. I was drafted at that time, although I did not wind up going. It was a very difficult time for my generation, and he was not considered to be a great ally of my generation.
And so what do you believe will be the lasting legacy? You mentioned some very complex matters that are going to leave people thinking one way or another, especially depending upon the role that they played in the broader U.S. relations internationally at different levels of the totem pole, for lack of a better analogy there. So all of these things considered, what will be that legacy, and what can future U.S. diplomats remember about his own way of conducting business, his own way of relationships, and perhaps learn to do things better in some cases?
Well, there's no doubt that he was the most consequential Secretary of State for my generation. And when I look back on his legacy, which really was so tied to Richard Nixon and so tied to Nixon's foreign policy, as well as the fact that tied to a certain extent to being with Nixon at a time of Nixon's impeachment. But I think his legacy is really going to be focused a great deal on two major issues. One, the enormously successful opening to China, and two, the enormously challenging and what I would call dangerous escalation of his support for the war in Vietnam. And while he may have wound up helping to bring about an end to the conflict, it was, to many of us, a conflict that extended far too long, because he and Richard Nixon were not prepared to end it as quickly as it should have been ended.
And Ambassador, just exploring a little bit more just on the U.S.-China relations, what you mentioned earlier, just in terms of Kissinger's really pivotal role in furthering the U.S. relation with China. He was just in Beijing in July at the age of 100 years old, which is just pretty remarkable within itself. Now that he is no longer a part of the picture, no longer one of the messengers here, or one of the players, I should say, within this relation, how do you view it as a former ambassador, and I know to Morocco, but how do you view the U.S.-China current relations and what those next couple of steps could potentially look like?
Well, there's no doubt that the U.S.-China relations was heading into a deep dive over a cliff, and that we hope that President Biden's meeting with President Xi, which appears to have been quite a success, has put more guardrails on this relationship. Just think of where we were when Henry Kissinger went to China. There was enormous threats to Taiwan, an escalation of threats after Nancy Pelosi's visit. The United States and China were heading on a collision course on trade. The United States and China were at odds with each other over its support for Russia in its war against Ukraine. There was a complete breakdown of communications militarily as China continued its imperialistic designs in the South China Sea. And I think Henry Kissinger, in his latest book, tried to put this in perspective. But frankly, how can you put it in perspective when President Xi's own policies were clearly more designed to compete with the United States in a way that would undermine U.S. interest in the Pacific, rather than what I would call cordial relations? And perhaps he may have had an impact on President Xi. We don't know yet.
All right, Ambassador Mark Ginsburg, former White House Middle East advisor and former ambassador to Morocco. Thank you so much for taking the time here this morning. We appreciate it.
My pleasure.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Welcome back, everyone. You're watching Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the start of the last trading day of November. My gosh, here. All right, well, we're getting closer to the start of the first trading day of December, I suppose. Anyway, let's talk a little October PCE. That report showing inflation continues to moderate this morning. We're taking a close look at the major averages throughout the morning. The S&P 500, you're seeing that hold on to some slight gains right now by the hair of its chinny chin chin. It's up by about 0.1% right now.
And taking a look at some of the individual movers this morning, Build-A-Bear Workshop reported sales as soft as their bears this morning, causing the company to cut its full-year forecast ahead of the holiday shopping season. You're looking at shares off just over 2% in early trading.
All right, not bad, Shauna. All right, Express also
under words there.
Yeah, I know, right? Love it. Express also under some pressure today, though, as the fashion retailer reported a wider than expected loss in its third quarter after acquiring the e-commerce company Bonobos. Express also saw heavy promotions taking a bite out of margins in the quarter.
And Big Lots making a big turnaround in its most recent quarter, reporting a narrower than expected loss. Now the retailer saying that it does expect fourth quarter operating results to rise on a year-over-year basis. The company cited reduced promotional activity, lower freight costs, and cost reduction initiatives as catalysts for improved sales and margins. Another company on our radar today is Royal Philips. Once known as one of the largest consumer electronics brands in the world, has shifted its focus to health tech in the last 10 years. Now organized into three main divisions: personal health, connected care, and diagnosis and treatment. The company is a leader in diagnostic imaging, ultrasound monitoring, enterprise informatics, and personal health. With us now to discuss the evolution of the company, some of the recent challenges, and the future with AI, we want to bring in Roy Jacobs. He's the CEO of Royal Philips. We also have our very own health reporter, Anjali Khemlani, joining us right now. And Roy, it's great to have you here in studio. So you can just basing it off the intro right there. And I know we've dug into the company here this morning. A lot of changes have taken place in a short amount of time. So talk to us just about where you are in the transition and the reliance that you have on AI technology going forward.
Yeah, you see that there's a huge healthcare crisis going on. And actually, I'm just coming off the back of the Chicago Radiology Show. 38,000 people joining us there, actually back to 2019 levels. And what's very clear, that there are just not enough people to take care of all the patients. So if you look at what we can do to support, then technology needs to really step in. And in that, AI is the next revolution that we can bring in to really make meaningful difference. And if you take an example, currently 70% of radiologists are reading from home because they need to read images over multiple hospital systems. Then actually it's very useful if you have AI helping and guiding them with the images that are transferred, but also how they can pre-read. You can do a pre-selection on negatives, but also indicate where they need to kind of put their focus on. We have another great example where actually in Buffalo, we are heading out with a mobile CT scanning program on the fire brigade, because actually, unfortunately, we know that there's a 60% higher chance probability of lung cancer if you are in the fire brigade. So we did a full screening program in the community by actually putting our CT with AI and very easy workflow outside of the fire brigade station so that everybody could get scanned. So you see that actually there are day-to-day applications here and now that can help the healthcare providers providing meaningful care with an enormous pressures system.
And certainly opening up a new avenue for consumer healthcare as we know it, because you have sort of this middle market that's not quite consumer, not quite clinician. And so that gives you the opportunity to create more products. We cannot start off the day, of course, without talking about the past. You have had the largest recall with the respiratory machines, and just recently the FDA called out again with overheating problems. Do you think that there's something to be said about how complicated it is to, in this world of high tech, create safe products for users to use that aren't in the clinical space?
Yeah, patient safety and quality is paramount. And that's something that also, when I stepped into the role, I said is the number one priority for the company. We have put a world-class team on it, and we are working through the challenge and actually making significant progress. We also saw that coming in, how the Philips recovery over the full year is shaping up. We have now 4 quarters of growth. We are actually year to date ahead of the plan. We upped our guidance twice. And we're doing that under the umbrella of looking at healthcare and how we can provide the best quality care to them, looking at the time that we can give back. But of course, also making sure that in the application, for example, of AI, we do it in a responsible manner. We are part of a consortium, for example, in North America. The National Academy of Medicine has gathered tech companies, providers, regulators, government officials to look at a code of conduct that we are together developing for responsible application of AI. Because AI can come to the rescue, but of course you need to be aware of what it can and cannot do. There's a lot of routine tasks that you can go after now to get immediate impact, as I was just sharing. But of course, the closer you get to the patient, the more careful you need to be, whether you have really well tested it, whether you do it in an inclusive manner, and that's something we are doing with cross-industry participation.
Where do you believe are going to be the biggest kind of accelerants in terms of the order book right now? Because that, in the most recent quarter, down by about 9% year over year. So what are those catalysts, at least kind of from the sources of customers that you're looking across?
Yeah, so first, we see the source of improvement or strengthening of the healthcare system itself. When we are looking last year and this year, last year 7 out of 10 hospital systems in the US were negative territory. They've turned positive again. So you see that they are strengthening kind of in terms of their financial means. At the same time, also, the challenges I was just calling out, they need to actually have solutions to deal and treat more patients. So actually also for them as a revenue generating engine. So that drives kind of also orders. At the same time, some of the software orders that we are talking about with AI also can come in through OPEX. So the orders that we are measuring, and if you look at Philips, 40% of our business is coming out of a CapEx order book. 40% is actually coming out of consumable services and software, 20% out of personal health consumer. So actually in that part where you saw the decline was the CapEx order book. Now we also see that actually strengthening. And then we see also the orders growing in the services side, and personal health is also coming back stronger. So where you saw at the beginning of the year, consumer were still more subdued. Actually, we saw now in the third quarter, we had 7% growth in the consumer segment, and we expect that to continue. Then there's another element, China, that actually played into the order book because China put in place new regulatory measures in the second half of this year, which actually does put the orders from China under pressure. That's a market pressure. We expect in 2024, as they work through their program, that will gradually return.
China, a country, that you've been in for 100 years, as we know you marked this year. But talk to me about the AI part of it, because there is this big push in healthcare in particular with regulation and the need for it. FDA Commissioner Robert Califf told us so just a few weeks ago. So what is it that is sort of stopping progress right now, or what needs to take place in order for you to be able to get your devices better flowing out there?
I think when you want to move healthcare, you need to think in a systemic manner. And therefore, 4 individual drivers have to line up. It's not only the technology and innovation. Actually, it's the clinical practice that is ready to adopt. So you need to actually train them and have them willing to work with new technology. Then it needs to be financially supported. So the reimbursement streams need to be adapted to also actually support the new technology. And then you have the regulatory stream that needs to come together. So that's also why we're working together to actually shape that. That does not mean that actually today you can do a lot, right? What we're discussing again this week is how can you actually get faster reading? We have an MR that actually with Smart Speed AI can have 3 times higher throughput of patients. So you can make the current system more clever, therefore actually treating more patients, which is great. But of course you need to look at it at a wider scale, and that actually then requires the full system to move.
Roy Jacobs, who is the Royal Philips CEO, and Anjali Kamlani, Yahoo Finance's Zone, joining us here for the conversation. Thanks so much for taking the time today, Roy.
Thank you for having me on the show.
Appreciate it. Thank you. All right, everyone, we've got to get to some breaking economic data that's come out at the start of the 10 a.m. hour here. Pending home sales, we're continuing to track that. That fell 1.5%, and that is month over month here. That is above the estimate and what was expected to come in here. Ultimately, it was estimated to be down 2% here. And then this is the lowest national index since its origination in 2001, we should also note here as well.
Yeah, more than 20 years. And when you take a look at the regional basis, what we're seeing in terms of these numbers, only the Northeast saw monthly gains in these pending transactions in the month of October. That's on a monthly basis. Now, when you take a look at the year-over-year, on a year-over-year basis, all 4 U.S. regions did see a decline in transactions. And obviously, as we've been talking about now for months, we have seen a massive slowdown in the housing market as rates have spiked. We were near 8% not too long ago. We have been trending to the downside here over the last 4 weeks. So exactly what rates need to get to, what they need to fall to in order to spur some of that activity here has been up for debate here on the street. We've talked to a number of experts over the last several weeks saying that maybe that 5 to 6% range is very critical. Getting at least down to 6% should help move some inventory or get more inventory back online, because so many homeowners right now locked into their homes with those lower rates. So again, pending home sales falling to the lowest level that we've seen in 20 years last month.
Yeah, absolutely.
All right, we'll keep right here on Yahoo Finance. We've got all your market action ahead. We'll be right back.
As we hit the last day of the month, it's shaped out to be a somewhat fairy tale month for equities. Let's bring back in our own fairy tale reporter here, Yahoo Finance's Jared Blickery over there. Hey, Jared.
Hey, Brad. Looks like we're closing out with a mixed board today, but definitely tacking on gains for the month. Let's take a look at the Dow Jones, 21 days in the month of November, up 8%. Nice return there. S&P 500 up a little bit more, 8.5%. And the Nasdaq, once again, just really taking it home, up over 10%. And just taking a look at some of the sectors, we've seen tech just really come back. We had tech leading through July, then we took a 3-month break, but now is back in the number one slot right now. Real estate, consumer discretionary, and financials, all of those outperforming and up more than 10%. Industrial is also up more than 8%. Even energy, which has been a laggard most of the month, still tacking on gains of about 0.5%. And we look inside some of the leaders here. I mentioned ARK in the previous hour. It is up 33% this month, and I checked, it's its best month ever, going back to its late 2014 debut. Meme stocks up 20%. That's an ETF. SOX is chips. Then we got software, home builders, Korea, regional banks, New York FANG. That's the mega caps. Just a lot of outperformance there. So what is not working this month? Small oil players. That's the PSCE. And the VIX. VIX has been trending down because it generally moves opposite to stock prices. Want to show you what's going on in the Nasdaq 100, then we can take a look at what's going to happen potentially for the rest of the year. And here we see the mega caps really carrying the water for the rest of the market as they have all year, but they had a lot of friends joining the party this month. And in fact, if we sort by performance, we can see Everything on the top row here up 18% or more. Datadog up almost 45%. Pinduoduo in second place, up about 43%. Well, I said November is ending strong. Let's take a look at December. This is the average year going back to 1950, at least pre-election years. This is the third year of the presidential cycle, going all the way back to 1950. The purple line is what has happened. The cyan line on top is what the average is. And you can see there's a very close correlation. Pretty impressive that this cyan line was generated at the beginning of the year without any knowledge of the price history. What we want to focus on is December, and guess what? It's up, up, and away. Typically, it doesn't start out too strong, but usually in the middle of the month when traders start going home for the holidays, that's when we see that low volatility rise. Now, one caveat, I've been talking about the seasonality and how that potentially affects the Santa Claus rally at the end of the year. We have seen such strong gains in November that a lot of that might have just gotten pulled forward. Maybe December will just end up being a ho-hum month. Even if it does, I think investors will be really happy with the returns they've managed to eke out this year.
All right, Jared, thanks so much for breaking that down for us. We want to turn back to one of our top stories of the day. Elon Musk slamming advertisers who are boycotting X after his endorsement of an anti-Semitic tweet. Now, he said, quote, "Don't advertise as someone is going to try and blackmail me with advertising, blackmail me with money. Then go bleep yourself." I think we can all fill in that blank there. Well, after that tirade, what does the future of X look like? I think a lot of people are asking that question this morning. We want to bring in Jim Anderson. He's the CEO of Beacon. And Jim, you're the perfect person to talk to about this, just in terms of advertisers, the behavior, how they look at someone like Musk, given the pattern in behavior that we have seen from Musk play out over the last several years. What do you think, just in terms of how big of an issue this obviously is for X, and whether or not an advertiser is going to feel comfortable advertising on X and that platform anytime soon?
Yeah, Shauna, you just said, I mean, it's funny. We just heard how well the market is doing for tech. Your previous guest was talking about AI and how that's transforming healthcare. What AI can't do is control Elon Musk and what he's going to say up on stage. I think yesterday, from an X perspective, has to be considered an unmitigated disaster because he basically told the people who paid the bills, "We don't want you. We want you to go away." And he used a very profane expletive to do that. And when you're an ad-supported business and you talk to your advertisers that way, it's really hard to spin that as anything other than a disaster.
So ultimately for X, that has already lost, about half of its value, at least from the time of purchase, or at least the price that he paid for Twitter at the time, now X, as it's been rebranded. Where do they find additional sources of advertisers, and is it nearly going to make up and get them back to what they had been able to see prior to all of the changes that had taken place at this platform?
Yeah, Brad, two-pronged answer to that. One, just go to Twitter or X and look at the advertisers, right? You see a lot of direct response advertising, what some people would call lower quality, not the big brand advertisers, not the Disneys of the world. Very effective advertising in its own right, but it's just a very different mix. It's kind of what you might see on late night TV is probably what most people think about it. And then will that make up the difference? Probably not, right? That requires, those rates are typically lower than what you could charge, a premium that you could charge to a company like Disney if you aggregate the right kind of audience. And so I think the big question, and we heard Elon Musk say this yesterday, will you use your personal fortune to make up the difference? At least in his quotes yesterday, he said, no, if Twitter fails, then Twitter fails, and we'll just let it fail and we'll blame the advertisers, which is another really remarkable statement to say you're going to blame the advertisers who are skittish and are backing away from you and claim that it's their fault. So it's a very combative approach with your customers, which I have to say is pretty much unprecedented as far as I've ever seen.
Yeah, he is quite remarkable for the euphemism side. We'll leave the dysphemism for later. But ultimately here, as we kind of look at some of the other players that would potentially see some of that load that now is kind of coming off of X or Twitter, and perhaps looking for other places to advertise, other kind of sources of continued engagement, of time spent online. Who seems best positioned to take that on? Well,
the names that we all are going to recognize, Meta, the owner of Facebook and Instagram and Threads, Google or Alphabet, more accurately, owner of YouTube, Google. Those are the big companies that are obvious. Of course, television, we're coming up into a political season, so I think a lot of local television affiliates are counting on an influx of political advertising dollars. So I think, to the degree that those dollars shift away from Twitter, everybody in the ecosystem is going to benefit. But I will say that Twitter has always been a smaller player. It's not like this is a massive sea change in the distribution of ad dollars. Twitter is a player at a certain scale. And so if they lose half of their advertisers and that gets distributed to other larger players, I think it's going to look like very incremental gains to a company the size of a Meta or an Alphabet, aka Google.
Well, Jim, bringing it back here to X, Linda Yaccarino, and she has to be scratching her head here this morning. She was brought in to do this job to really improve the relationship with advertisers. Has Musk essentially made it impossible for her to do her job?
Yeah, you'd have to ask her that, but I wouldn't want to be sitting in the audience like she was reportedly yesterday, hearing he's not your CEO because you're the CEO, but everybody knows that Elon Musk is sort of the ultimate person who calls the shots in his companies. And so to hear him blatantly criticizing, insulting, using profanity to advertisers, including very large advertisers like Disney, she's gamely trying to spin that as, we're into free speech and you need to support our mission. I think she's got a very tough road to get people to buy that. I mean, what else is she going to say? I'll give her credit for she's doing the best she can under the circumstances. But really, does anybody believe that was just a paean to free speech and that Elon Musk is really principled and loves advertisers? He just maybe was not fully understood. I think that's going to be a very, very hard road for her.
Yeah, not a job that anybody would be immediately envious of, at least in that room and right here on this desk. Beacon CEO Jim Anderson, thanks so much for taking the time here this morning.
Thank you.
Thanks. Well, it appears the engine is finally revving at Tesla after sputtering out several times over the past few weeks. The famed Cybertruck, pictured here and in dormant state, which was announced back in 2019, is finally launching in Austin, Texas this afternoon. The impact on the company has investors wondering, with our next guest saying it will undoubtedly be a halo effect across the Tesla brand. It doesn't seem to be shaking up any competitors in the EV space. On Wednesday, our own executive editor Brian Sozzi spoke with General Motors CEO Mary Barra on the subject. Here's what she had to say.
Well, I always take every competitor extremely seriously. And so we'll watch as it evolves. But again, I think we know trucks. And when I look at the trucks, the feedback that we're getting from the fleet customers already gives me confidence in our truck portfolio.
So let's bring in Autolist Editor-in-Chief David Underkoffler to discuss more. David, okay, I continue to just be, have my, bottom jaw just kind of slack-jawed every time I see this thing on screen and this Cybertruck. So what are the expectations by the end of the day today? Will people be blown away, or will this be perhaps a nothing burger if they can't get the price and the delivery correct?
I'm going to go for the third option and go right in the middle of the road. I don't think anyone's going to be blown away. I think everyone was blown away when we first saw it. It's a very striking, dramatic design. So there's no surprises there. The production version looks largely like the concept we've seen for a number of years. But I think what everyone is curious about are like the meaningful metrics, right? Like you said, price. That's going to be everything to a lot of buyers. We also don't know things like range of this vehicle. We don't know if it's dual motor, tri-motor. There was talk of a single motor originally, but that's probably not going to happen now. We don't know payload, the truck metrics, right? Payload and towing, we don't know those yet. And horsepower as well. So I think there's a lot of sort of the nitty gritty details that really sort of make this, popular. People are looking to find out today.
When it comes to what makes it popular and who is actually going to be out there buying this Cybertruck, I know you've been digging into this. What did you find?
Yeah, so we at Autolist, we run an annual survey every year, gauging consumers' interest in electric trucks. We ask them sort of a hypothetical matchup of all of the ones that automakers have talked about. So not just what you can buy today, so that would be Ford and Rivian and the Hummer truck, but also models that are expected. So that'd be models from, like Mary Barra was just talking about, the Chevy Silverado, there's a Ram version coming, an electric Toyota Tacoma. We paired all those up and said, look, car shoppers, which seems most appealing to you? We've done this for a number of years. This year, the big winner was Toyota Tacoma. Overall, if there's an electric version, and again, this is hypothetical, but an electric version of that truck had a widespread appeal. So to people who owned trucks previously, who had never owned a truck, to different sorts of age groups, that sort of was the main overall winner. That sort of kicked the Ford F-150 Lightning out of the top spot. Previous 2 years, we'd seen a lot of enthusiasm around the Ford. Now you can go buy the Ford. So I think the novelty has sort of worn off that truck. And then the Cybertruck definitely was the winner among people who had owned or currently own an EV. So EV owners are very enthusiastic about the Cybertruck. I think there's a big audience and a lot of potential there. And then also younger buyers, Gen Z, were the buyers who definitely favored the Cybertruck overall.
I mean, but it comes down to financing too. I think especially even for Gen Z, many of them, my gosh, the kind of age range continues to elude me.
Makes you feel old, doesn't it?
It really does. It really does. And I was trying to be really generous to myself there. But at the end of the day here, it comes back to how much, even at different kind of consumer cohorts, they're willing to spend into an experience where you're still waiting for there to be this broader investment that's starting to take place in a charging network at the end of the day. Does it feel like there's confidence around the existing network in order to buy into an EV experience right now?
The short answer is no. You know, we, in addition to this electric truck survey, we at Autolist also poll every year just a broader EV survey. We've done that for a number of years. And both of these surveys, year over year, it's the same three reasons that people are concerned about EVs. It's the price of them over an internal combustion version of that vehicle. It's the range that EV can travel. And then it's also, where am I going to charge it? And the charging is becoming a more critical pain point for consumers. You know, infrastructure is still lagging. You know, we're seeing some investment both on the private level and then a public level in that, but it's still not solving you know, consumers' pain points of like, look, maybe I'm on board, you know, in theory with an electric vehicle, but if I own it, I don't know where I'm going to plug it in. I don't know where I'm going to charge it. And that's a huge concern for consumers of all ages, not just Gen Z.
David, going back to the thought that we played in the intro, the soundbite there from Mary Barra, the CEO of GM, and our colleague Brian Sazi asked her about the Cybertruck, and she didn't really brush it off. She said that she always has her eyes and closely tracks anything that competitors are doing, but she did reiterate, to no surprise, that she's very confident in GM's lineup of EV trucks. How big of a threat do you see the Cybertruck as a threat to some of the more traditional automakers and their lineup of EV pickups?
I don't see it as a big threat in terms of outright sales, right? Like Mary Barra was very clear, and they know their trucks. It's something they've been succeeding at for decades now. Even as they're shifting to electrification, I think they're pretty confident in maintaining a pretty strong user base. So I don't think it's going to steal sales necessarily, but I do think it's going to force people's perceptions of what an electric truck can be. It's going to force automakers to evolve their interpretation of that. I mean, that's what Tesla did, you know, famously with the Model S. Electric vehicles 15 years ago were not sexy, they weren't aspirational, they weren't luxurious, and the Model S came in and sort of shadowed all of that. And so I think you may see some perceptions shift a little bit as a result of the Cybertruck. I'm glad it's out there. It's a refreshing take on trucks, but I'm not going to go out and buy one. So I think automakers see it as potentially something that kind of, it's going to evolve kind of what consumers may expect out of their vehicle.
This is still a company that has two mystery machines that have yet to be unveiled here. And if you take a look at some of their Investor Day materials from earlier in the year, essentially it's just kind of a Casper the Friendly Ghost type of cloth over type of it. How much does this Cybertruck also set up the introduction of those vehicles, and does that make or break what that looks like in the fanfare?
That's a good question. I think this Cybertruck, it sort of sets the tone for Tesla and sort of the future of the company. I don't think, though, materially it's going to have an outsized impact on sales. I mean, it may have like a halo impact on maybe the share price a little bit, but in terms of sales, I've said it before, the bread and butter of Tesla are the Model 3 and the Model Y. And there are updates, pretty significant updates expected to each of those vehicles in the near future. So I think, they're going to look a little different. There's going to be potentially some different battery technology, potentially the range changes on those vehicles, and then the price as well. So I think those changes to those vehicles does a lot more sort of broadly and holistically for Tesla, for its sales, for its share price, kind of overall. That's where you kind of need to look. The Cybertruck is, I don't want to call it a distraction, but I think it's more sort of icing on the cake rather than kind of, what's underneath. That's the Model 3 and Model Y.
All right, David Underkoffler, always great to get your insight. Thanks so much for taking the time to join us. We appreciate it.
Thank you, folks.
All right, we're going to take a quick break, but keep it right here on Yahoo Finance. We've got all your market action ahead. Stay tuned.
Shares of Nutanix gaining ground this morning. The cloud service provider beat Wall Street expectations in its fiscal first quarter here against the challenged economic backdrop. The company enjoyed boosts across free cash flow and billings. But in the fiscal year ahead, they noted it's been a stellar 2023 for the company thus far. Shares up almost 60% year to date here, a little bit over that as of this point in time. Rajiv Ramaswamy, who is the Nutanix CEO, joins us now. Great to see you, Rajiv. We just were speaking with you in Times Square a few weeks back here off of the Investor Day. So notably here, going into 2024 and what you've been able to kind of set up and communicate to the investors here on the day and on the back of this report, what are some of the biggest catalysts that you're going to be looking for going into the start of next year?
Yeah, I mean, we just, by the way, started our fiscal year. This is our first quarter of the year, and we were pleased to we were exceeded all our guided metrics. We also were pleased to raise guidance for the full year. And what's driving all of this at the underlying heart is our customers. Every company is a tech company. Data and applications are critical, and where to place them, how to run them are critical to every company, including you at Yahoo. And so this is what we do. We help companies, run their applications and manage all their data wherever they'd like to run it, inside their data centers, in public clouds, or at the edges. And that's really at the core driving our growth, because it's critical for most companies to go digital.
Rajiv, when it comes to AI and what you were doing there, that's also a big driver here as we look ahead to 2024. And something that you mentioned on the earnings call caught my attention. We've been talking a lot about your products right now. It actually also caught the attention of an analyst as well. But the GPT in a box, you have your first big customer, it sounds like, there. What can you tell us just about that partnership and I guess what that adoption rate looks like here in 2024?
Yes, it's still very early days for us with GPT in a box. We just actually launched the platform a couple of months ago. And what it is simply a turnkey platform for companies to run their AI applications on our stack in a very easy way. Now, I think AI needs to run where the data is. And data is everywhere, like we've said, and we provide a secure way for companies to easily run those applications. Now, we were happy to have gotten our first win this last quarter here, and this was with a large federal agency. The use cases that we are seeing in terms of what customers are trying to do with this: first, automate customer service. Second, a lot of applications when it comes to document search, document analysis, document retrieval. The third, fraud and investigating fraud and more creative ways to figure out fraud. And the fourth is co-piloting. These are the use cases that we're seeing. And again, we're thrilled that one of our large customers in the federal space actually has gone out and started using this for one of these use cases.
And what type of revenue then do you see generated off of something like a GPT in a box? And how replicable is that experience across all of your customers?
Oh, I think it's going to be fundamental to every customer because over the last 6 months, as I've had conversations with customers, every customer is thinking about how to use AI to improve their products or become more productive. And so a lot of new applications going to be built are going to be around AI, and they need a platform to run these. I do think it's going to be a bit long-term, though, because most companies are only now trying to figure out how to do these things. What is the ROI on automation that they can get with AI? And so I think it's going to take some time for this to build up into production from a lot of interest today to actual revenue delivered at scale over the next few years.
Rajiv Ramaswamy, always great to have you here at Yahoo Finance. Congratulations on the most recent quarter. We look forward to talking with you again soon.
Thank you, Shana and Brad.
All right, Microsoft snagging a non-voting observer seat on the OpenAI's board. Now, the position comes with Sam Altman back as CEO after an abrupt and brief ousting. This has all played out over the last several weeks. Now, OpenAI's board now consisting of Bret Taylor, Larry Summers, Adam D'Angelo, and a yet-to-be-named Microsoft observer. Now, D'Angelo is the only remaining holdout from the previous board that removed Altman earlier this month. Now, it's important to point out, like we just said, they're a non-voting member here of the board, just in terms of what this means here for the company, what it means for Microsoft, obviously just furthering the ties between the two. Microsoft largely viewed as a winner of all of the drama that has played out with OpenAI, going back to Satya Nadella moving very quickly, saying that he would hire Sam Altman here to run Microsoft's, what they were thinking about at the time, newly created AI team. Now with Altman back at OpenAI and Microsoft as an observing member here of the board, clearly just furthering those ties and also making them even maybe a further leader within this AI race that's playing out.
Yeah, the board restructuring was certainly put forward as one of the ways for a lot of the employees to be retained over at OpenAI as well, who, in addition to the rebuke of Sam Altman being ousted in what was an apparent coup by the board at the time, which has now since been reshuffled around and the seats changed over as well, there's a larger consideration that I think for some of the larger and biggest investors into a company in OpenAI that perhaps Microsoft could have taken this stance before, saying that they wanted a board seat, but they decided to let OpenAI early this year, even though they had announced that they were moving forward with this partnership. The dollar sign later came to be reported about $10 billion over an extended period of time. Microsoft probably could have pursued that before. They did not. Now, as a result of all the kerfuffle that came about in most recent weeks, they had to do this ultimately, and making sure that in their multi-billion-dollar investment that they've got with OpenAI and this partnership now, that they have a little bit more hands on the reins, as this company is core to their own ambitious growth strategy with anything that is annexed to generative AI right now. In other board news, activist investor Nelson Peltz reportedly seeking 2 seats on Disney's board as well, according to CNBC here. Now, this should come as no surprise, as it's also been a year of activist campaigns around the House of Mouse here. One huge thing that Bob Iger has continued to try and communicate to the street and puts to rest some of the concerns around the activist campaigns that started really in the first quarter of this year, came about, and Bob Iger on the earnings call really had to address everything, and we heard one of the most stern versions of Bob Iger, all business Bob, that came about and essentially said, hey, we're restructuring, we're cutting thousands of jobs, we're reframing exactly how we're looking across the square footage that we've got at the park experience, and we've also got to figure out what to do with ESPN, and we're going to start reporting that out differently. That quelled those concerns, at least for a few months. But as of right now, where you've got the stock that is well off of the year-to-date highs, in fact, at some of the lows that we've seen multi-year, there are more questions to answer for Disney, and these board seats are going to be coming after. They're going to become after, or they're going to be highly coveted, I should say, among some of those activists that we heard from earlier on in this year that are going to reinitiate some of their activist campaigns.
Yeah, we know that this development coming after Disney just appointed James Gorman, the CEO and chairman of Morgan Stanley, and also the former CEO of Sky. Those two people as new directors. That's going to happen. The appointment is going to be effective next year. As you look ahead to Gorman's is effective at least on February 5th, but that wasn't enough for Pelt and Tryon. We know that they have been persistent in some of the challenges that they have said to Iger, saying that they are not satisfied with some of the changes that have been laid out in terms of the turnaround plan and what exactly Iger is planning to do in order to reinvigorate some of the growth there at Disney. And we know shares have been under a tremendous amount of pressure, not too far from the lows that we saw recently. So again, we'll see how exactly all of this plays out.
That's right. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Consumers shelling out record amounts of money this Black Friday and Cyber Monday, looking for deals amid persistent inflation. A new report out from Klaviyo, though, finding that nearly half, 47% of purchases were actually repeats as shoppers search for price cuts on some of their favorite items. For more, we want to bring in the CEO of Klaviyo, Andrew Bialecki. And Andrew, it's great to see you again. Let's start here with this report, because the 47% who made repeat purchases, is that a bit worrisome? Does that mean that maybe this holiday season could be a bit disappointing?
Yeah, I don't think so. You know, Klaviyo is all about powering smarter digital relationships between businesses, brands, and their consumers. And I think that 47%, I mean, that's a great sign that those businesses are building durable relationships with their customers. And I think one of the key things we've seen this season, one of the trends is consumers are voting with their dollars, and they're saying they're going to the brands that they love, brands that are, you know, delivering an awesome experience, awesome products, and that's where they're looking first.
Yeah, I'm sure those brands love to see that high replenishment rate among some of those consumers, where they've got strong relationships that continue to move forward here, even during consumer spending downturn in some other core categories here. If there is one way that you would paint the strength of the consumer in this holiday season and where that's expected to move forward once we're kind of on the other side of the holiday season and some of that spending begins to subside, how would you describe the state of the consumer?
Yeah, well, like we said, I mean, we were really excited to see across the 130,000 businesses using Klaviyo, you know, brands like Spanx, Good American, Way. Consumers and businesses, they're communicating a lot. You know, at peak on Black Friday, Cyber Monday, we were sending over 11 million messages to, you know, different customers per minute, and consumers were responding. They were enjoying the deals, the products they were seeing. Consumers were spending over $60 million an hour, you know, based on those messages. So we look at that as like, that's a really strong sign that businesses are doing a better and better job of connecting with consumers. And what's great is, as we've seen a lot of the advancements in AI, businesses are starting to really leverage that technology to build better experiences for folks.
Andrew, do you think that that's almost a separating factor here this holiday season, the edge that AI and that technology, if you use someone like Klaviyo, like yourself there, just in terms of being able to connect with customers, how big of an edge is that giving those brands in your view?
Definitely. I mean, one of the other really great, wasn't surprising to us, but one of the other great stats, over 600 million messages sent through Klaviyo over the holiday weekend, included AI personalization. So you can think of things like product recommendations. Hey, if you bought a shirt, we noticed the pattern, the size, what other similar customers are buying, and we're now recommending things to you rather than just showing you maybe, what's on sale or our best selling products. We found that messages that used artificial intelligence, they had a 40% better conversion rate. So we're really excited to see, one, that a lot of businesses and brands are adopting that. And then two, it's that personalization is paying off. Consumers are spending more.
I mean, you say that some of these companies are really just getting better at optimizing their customer engagements. I say for myself that I'm becoming worse at cost discipline, and I am just succumbing to all of the messages that continue to come my way in one form or another, perhaps on my own consumer basis. But when you think about the data sets that these companies are able to leverage in order to identify the right time of day, the right type of message, what's going to resound with the consumers, where are these companies leaning into to identify where those success points are actually going to come as a result of being able to layer on this artificial intelligence?
Yeah, well, one of Klaviyo's mission is really to empower these brands, these creators, to own more of their own data and put it to work. And so one of the things we're doing is helping them use the data they already have and learn from it. So things like, when is the best time to send? What kind of language is resonating? So that's stuff that, software now, and obviously we can help with this, that software can do for marketers. And that's actually letting marketers spend more of their time being creative. We think about the Black Friday, Cyber Monday as a time when brands are doing a lot of discounting. We've seen some really creative ideas. For instance, Viore, a brand that I love, rather than offering a discount, when you buy a pair of joggers, they're offering, more products, a free hat. I've also seen other brands, they're offering, on Giving Tuesday, if you're willing to donate to charity, they'll give you a discount. So they're starting to get creative with campaigns that are really on brands. And then some of these details, like when's the best time to send an email or who's exactly the right audience, all of that stuff can really be left to the software.
Andrew, let's talk about the fact that now you have been a public company for several months. I want to bring up the stock price because you, along with some of other companies that have entered the public markets more recently, have seen some pressure on share price, and we're looking at a decline of nearly 8%. I'm curious what your message is to shareholders right now, what you see as a catalyst for Klaviyo as you look out to 2024.
Sure. Well, we don't spend a lot of time worrying about the day-over-day fluctuations. I think our mission, our strategy are rock solid. And I think if you look at the results from the businesses we've worked with, even over the last couple of days, our strategy of building software that unifies the customer data and then having that play into the messaging and the experiences brands are delivering, giving them ownership of that and being able to show the value through a metric that we've defined, Klaviyo attributed value, revenue that they're actually can see dollars in their pocket. We think that's going to be a great business.
All right, Andrew Bialecki, who is the Klaviyo CEO, joining us here today. Andrew, thanks so much for the time and breaking down some of the insights that you're seeing over at Klaviyo. Appreciate it. Well, consumers took an alternate route with their holiday shopping this year. Buy now, pay later drove $760 million in spending on Black Friday and $940 million on Cyber Monday. That's a year-over-year jump of 20% and over 42%, respectively, according to Adobe Analytics. But will the trend continue? We're joined by Affirm CFO Michael Linford to discuss this more. Michael, great to have some of your time here this morning. First and foremost, you hear those numbers and you think about the actual consumer environment where people see that Affirm logo or they think about buy now, pay later as a whole, and it seems like they're increasingly tapping into that. So what does that say to you about the strength of the consumer or the household balance sheet right now?
Well, I would actually take a step back and think about, this season in the same context that you would for the past 5 years. What you've seen is a broad adoption of a new payment method. Consumers are voting with their wallets and have been for many years now, seeking out alternative, safer, better credit products. And I think that whether it's this quarter or a most recently reported quarter, the fact is consumers are clearly preferring safer ways like our products. Our products avoid the traps of revolving credit. They are without late fees and all the other fees that are getting so much press these days. And consumers really do value that and they prefer that. I actually think it's a mistake to think about any sort of read into the consumer balance sheet and this product. This is a safer way for consumers to pay. It's a really good sign for consumer preferences. These loans are close-end, fixed, can't revolve, and they're safer for consumers because they always have an end, unlike credit cards, which are really designed to keep consumers revolving for a very long period of time.
Michael, when it comes to the purchases and the data that you've seen over the last week or so with the holiday season, what are consumers that are using Affirm and opting for that buy now, pay later service, what are they spending on?
Yeah, we're really fortunate to have a wide set of categories that we serve, everything from general merchandise to home and lifestyle brands to electronics companies. And the only notable trend is a continuation that we've seen starting with our most recently reported quarter, which is some of the COVID winners that really did see material declines throughout all of last year are beginning to show signs of real growth. And they're coming in categories that showed outsized growth during the pandemic, showed a little bit of compression and reduction last year, and are beginning to come back to life. And we think that's a really healthy sign for the categories and really for the consumer overall. The spending is broad-based and really touching across all categories.
Michael, we're currently looking at the highest balance among total credit cards here in the U.S. in the third quarter of 2023. It hit $1.079 trillion, according to the Federal Reserve Bank of New York. When you think about the service that Affirm offers and where you've got people able to pay in installments at the end of the day, is there any determining factor that you would look at among a consumer to say, okay, this doesn't seem right for us to offer this buy now, pay later, or buy now, pay in installments type of service or option to them?
Yeah, I mean, we think that level of consumer credit card debt is our opportunity. We think that all of that needs to go away and needs to be replaced with safer financial products like ours. Because we approve every transaction, we're able to look at the consumer's financial health at the time they're making a purchase. And our approval or decline decisions, or our decisions that inform the level or type of product that we're allowed to offer to a consumer, are informed by their ability to repay. That's a very different model than a credit card, where a line is established and consumers will experience stress or anything that happens in their life and still tap the credit card. Our ability to do transaction level underwriting allows us to deliver really strong credit results, which you saw last quarter. I mean, you compare us to the credit card banks, you saw delinquencies continuing to rise for a lot of those banks, and you saw our delinquencies coming down year on year. And as a result, you get an insight into how we think about the credit problem broadly. Our unique position at the point of sale allows us to say no to a consumer who really can't repay. That's something credit cards can't do, and why that credit card debt ultimately is really troubling for those consumers who fall into it, and why Affirm offers a better way.
Well, Michael, when it comes to those higher rates, we are seeing Wall Street increasingly optimistic about a Fed rate cut next year. What does that do then for your business? Is it a tailwind?
Yeah, I mean, I think anytime holding everything else constant, a reduction in rates is a good thing for Affirm. However, we certainly don't need a rate cut. We're pretty happy with the way we've retooled the business for the current rate environment. Last quarter, we produced very strong unit economics on the high end of our long-term guidance. We just had our investor forum in New York, and we walked through with investors our long-term framework and reiterated our confidence in delivering 3 to 4% unit margins. And that's because we've done a lot of really hard work over the past 12 months. And this season, this holiday season, this quarter, because of that hard work that we've done, allows us to refocus on making sure we're serving and delighting as many consumers and merchants as possible.
And Michael, just lastly, while we have you, is there an average price at which you're seeing consumers look at a product that they're ready to purchase, but saying, you know what, I need to break this up over a few payments? And how does that perhaps kind of look comped year over year? Are we seeing an increase or a decrease even in the average threshold where a consumer is saying, I got to break this up?
Yeah, the average order value for us is seasonal, so it varies by quarter and by category quite a bit. But it's been remarkably sticky through the past several years. I think there's a lot of consumer mindset around things getting up to a certain level where a $50 a month payment, for example, is a better option than a $600 outlay. And I think they think about it in the monthly payment amount much more so than the actual size. But part of the reason that we do drive higher average order values for our merchants is because we do enable them to get those things that are outside the range of what they can get without accessing safe credit.
All right, Michael, thanks so much for taking the time here today and giving us some of the insights into what you're seeing over at Affirm. Affirm CFO, Michael Linford, great to grab some of the time with you.
Thank you.
Thanks. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Coming up in our next hour, oil on the move this morning amid reports of another round of OPEC Plus cuts. We're breaking it all down next.
Plus, leaders gather in Dubai today to kick off the UN's annual climate change conference. We will we will hear from Andrew Steer, Bezos Earth Fund CEO and president. He's going to weigh in on more on what's needed to avert a climate catastrophe.
Yeah, we'd love that. And Beyonce's Renaissance concert movie on track for a big opening weekend, hot on the heels of Taylor Swift's Eras Tour film. More on box office expectations coming up during the 11 a.m. hour. Let's take a quick look at the major averages here. We've got some mixed activity on the tape. The Dow in positive territory, while the S&P 500 and the Nasdaq are in the red. Flat as it gets for the S&P 500, but just barely in the red there. And the Nasdaq down by about 0.6%, while the Dow's up 0.9%. That's it for Brad Smith, Shauna Smith, the rest of the crew. We'll see you tomorrow, Friday.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita. Here's what we're watching at this hour. The Fed's favorite inflation gauge comes in line with expectations, with growth cooling to 3.5% year over year. What does this signal for the Fed's path forward? And charging up, Tesla's much anticipated Cybertruck deliveries kick off today. But how many of those reservations will translate to sales? We're going to speak with a panel of experts. Plus, climate crackdown COP28 begins in Dubai today, where leaders meet to assess the climate crisis. We're going to speak with the CEO of the Bezos Earth Fund this hour. First, though, let's take a look at where major indices are trading. We are 90 minutes into the trading day, and of course, investors assessing the latest PCE data that came down. Let's take a look at where they are right now. A bit of a split screen here, with the Dow up 300, more than 300 points, the S&P 500 up 2, and the Nasdaq down just slightly. You're taking a look at core PCE inflation. That's largely why we've seen some of those gains in the market round. The expectation, of course, being that with that further cool down, the Fed will potentially pause when it comes to that next Fed meeting. Let's take a look at where Treasury yields are trading right now on the back of that. You're taking a look at green arrows across the board there. Yields rising across the board. The 10-year yield at 4.33 right now, and the 30-year yield at 4.49.
Well, Tesla fans can finally get their bums in the seat of a Cybertruck. After a lengthy development and production process, which CEO Elon Musk has described as, quote, insanely difficult, deliveries are finally being made at the huge event this afternoon in Austin, Texas. With hundreds of thousands of people having placed $100 refundable deposits on the car, this could be the biggest new vehicle launch in a while if those deposits translate into actual purchases. Now, obviously, for a lot of people, this is a moment they've been waiting for since 2019, Akiko, when the Cybertruck was first demoed, and we saw that, you know, that one customer throwing a bowling ball at the window and it shattered. You know, perhaps a bad omen, but here we are finally at 2023, a much more crowded market for the pickup EV space. So, I mean, we'll be taking a look at this, but a couple of things we still don't know. We still don't know the price. We still don't know in terms of the vehicle driving range, which is also going to determine how people view the price, and also don't have a clear timeline for when we'll see production really ramped up on the Cybertruck. It's only going out to, I believe, 10 customers today when we get the announcement at 3 p.m. Eastern time. And as we mentioned, will those $100 deposits, people who perhaps love Tesla, love Musk, love the brand, will that translate into actual sales, especially after some of his very colorful comments at the DealBook Summit there, you know, thrashing a lot of advertisers over its response to the tweet that he liked and contributed to that was anti-Semitic. We saw a lot of pullback there and clearly pushing some advertisers out of the way. But as we know, Tesla does not like to advertise. So this will be interesting to see how much fanfare comes of this and what investors make of it.
Yeah, I mean, there's a lot of Elon Musk news that we just sort of threw all in there. But when you think about where things are, to your point, that last line you said really is really key, which is how many of these $100 deposits are actually going to translate into sales? And that is a big question mark when you think about just how crowded this pickup truck market is now. We've talked about the Rivian, the F-150 Lightning, the Silverado, the EV version of the Silverado. So, you know, who is actually the customer? I mean, that's a big question for me moving forward. Elon Musk yesterday at the New York Times DealBook event saying that this is going to be the biggest product launch of anything far on earth this year. Of course, he's going to be hyping it up. It is his company. But a lot of questions going into this event. Let's talk about this, because since 2019, customers have been anxiously waiting for Tesla's Cybertruck, and they will finally start receiving them as the EV company launches its Cybertruck delivery event this afternoon in Austin, Texas. But while some investors are seeing this Cybertruck event as a potential halo truck for the company, there are still doubts about how large of an impact it can have and if it can boost Tesla's top line. Let's bring in RBC Capital Markets lead equity analyst, Global Autos, Tom Narayan, and The Verge transportation editor, Andrew Hawkins, to get their insights. Good to have both of you here. Tom, let's kick things off with you. Who is the audience? Who's going to buy the Cybertruck?
Yeah, I mean, this is a pretty specific niche customer base for sure, but this was never going to be a big volume product, right? So there were a lot of folks in 2019 that wanted this product. I suspect the conversion rate will probably be more like 20% or so, but still, if they could get something like 200 to 250,000 of these at maturity per year, off of a base, the US SAR is what, 15, 16 million, right? So I think that's actually very doable, even if it's a niche customer base segment, a cool factor, so to speak. But even more than that, I think this is going to be a halo car, really, for differentiating the brand. Folks are even talking about how they went into showrooms yesterday and they saw ads for a Model 3 for only $29,000. So it's really being used to sell threes and Ys. That's really how we should look at the Cybertruck, not as its own thing. It's really a halo car designed to incite demand for threes and Ys. That's where most of the volumes are going to come from next year.
So then, Andrew, I want to bring you in here, because if the idea is perhaps to get some of these future Tesla customers in at a lower price point by looking at the 3 and sort of having the Cybertruck as more of an aspirational, look at the brand situation here, but we still don't know the price yet. So as we look at the demographics of the people who've put these $100 deposits down, do we know much about how they're going to, whether or not they can afford the Cybertruck when we still don't actually know how much it costs?
Yeah, that's a great question. I haven't seen any demographic data on the people who are reservation holders at this time, but I think you can probably draw a lot of conclusions just based on assumptions that it's probably going to be a lot of early adopters, people who are turned on as opposed to turned off by the polarizing design of the Cybertruck. And I really agree with what everyone's been saying so far about how this is more of a halo car. I think Tesla's own employees have been describing it as sort of like a Lamborghini Countach more so than an F-150 or a Silverado. And I think that sort of highlights a lot of kind of interesting elements about the Cybertruck, which is that perhaps it's kind of missed its moment, right? When it was first announced in 2019, there were no electric trucks on the market at that time. And so if Tesla had actually released the truck and started delivering it to customers soon after that event, they really could have captured this market. But now we've seen there's the F-150 Lightning, there's a Rivian R1T, there's a Hummer truck, and there's more coming out. And by the time they actually get production running up at scale, we're going to see even more trucks on the market. So I think there's an argument to be made that Tesla kind of missed the moment here. And it's kind of a weird thing to have done, because trucks are just a huge business in the United States. They're huge volume, huge margin. This could have been really an opportunity for Tesla to dominate the EV truck market in the same way that it's dominated the EV passenger car market. And instead, we got this very polarizing niche car that's really going to only appeal, I think, to a small segment of really motivated Elon Musk fans, and not really much else beyond that.
Tom, two questions for you. Number one, do you agree with Andrew? Has Tesla missed its moment, at least with the Cybertruck? But number two, how do you think investors should be thinking about this car in terms of the revenue it's likely to drive within the company, not immediately, but at least in the medium long term?
Yeah, I mean, has it missed its moment? Very possibly. But I think folks who are in the Tesla stock, let's not forget, this is a stock that once was $1 trillion market capitalization. Now it's 700 billion. You're not going to get to these valuations on selling cars and trucks. Okay, so people are in this stock because of autonomy, right? Because of FSD, because of robotaxi. So whether or not you sell a truck now, this year, next couple of years, and it's profitable eventually, or cars for that matter, my valuation, only 10% of it is cars and trucks. 90% of it is autonomy. So while I do think it's important, right, that they sell Model 3s and Ys next year, maybe this can help. Kind of like the Dodge Viper helped Chrysler a decade ago, right, or decades ago. It's kind of like that. It reinvigorates the interest and energizes the brand. But, I look at this whole pivot that Tesla is doing to become a software company, kind of like what Netflix did when it pivoted from renting DVDs to streaming. Take a look at the stock that Netflix did after 2011 and then beyond that. I think Tesla's poised to pivot from selling cars and trucks to doing a completely different thing, which is becoming a tech and autonomy and software business. And I think that's really where investors kind of look at this. Cybertruck on its own, I think, is a niche product. It's never been designed to really be the main feature of this company. But certainly in the next couple of years, it could help reinvigorate the brand. Remember, these guys don't advertise. Their advertising is stuff like this, and it's Elon Musk, and it's the cult of personality and the cool factor that a new product like this brings. But ultimately, none of this is really going to matter. It's going to be all about autonomy and software and robotaxi and FSD.
And Tom, you raise an interesting point, because obviously Tesla doesn't advertise, but when you own X, when you have a platform where you can literally talk about your product constantly, it might not be traditional advertising, but it clearly is still advertising of sorts. But Andrew, I want to bring you in here because you talked about the Hummer, because I remember when Hummers came out, everyone was so excited. They're like, oh, there's nothing like this on the market. And then it became this eyesore because it was really an early adopter thing. And they tried with the H2 to sort of make it more palatable because of it, it was a gas guzzler. But what would be the backup plan? That if the Cybertruck comes out, what would be the alternative other than the existing Tesla models, you think?
Well, if you're out shopping for a truck, there's a few models that you can choose from. But yeah, I think that in terms of EVs, I think we've seen sort of broadly over the last few months, demand is sort of flattening. It's cooled off a little bit. We've seen a lot of the major OEMs pull back from some of their capital plans. Their big factory announcements are on pause. And EVs are just not selling as quickly as I think a lot of the industry assumed that they were going to. Tesla still is sitting pretty comfortably on around 60% of the market. I don't think that the Cybertruck is really going to move the needle too much in terms of how much market share that the company has been able to enjoy. And I think that we're actually going to see that start to continue to dwindle as we have over the last year or so as more models come on the road. And I think the real question is not whether or not the Cybertruck is going to change the Tesla story so much. It's how that next gen vehicle that Elon Musk and others have spoken about, that one that's $20,000 to $25,000, priced to be much more mass market, even than the Model 3 is at this time. That's the one that I think a lot of people are thinking about, especially in terms of what Tom was talking about with robo-taxis. Is that going to be the car that is going to then launch Tesla into this robo-taxi space that they've been talking about? I think that there's some skepticism around whether or not that FSD is actually mature and functional enough to be able to accommodate for that. But that I think is what a lot of people need to be watching for in the future, is this next gen vehicle that's more mass market, that was really going to help kickstart this adoption and transition wave into EVs in the future.
So let's talk a bit more about that, Andrew. I mean, you could argue that the slowdown right now we're seeing partly because the early adopters have already adopted that car. They've gotten the EVs they wanted. It is that next chapter that we're looking for. And yet when you look at the market, I mean, we're talking about pickup trucks here that are upwards $60,000, $70,000. What are the car makers? Who are the car makers you think are better positioned to capture that market where it looks like drivers are looking for a more affordable EV option? Right now, they're choosing the hybrid because it doesn't exist for them.
Yeah, I think there's a lot of interest around Hyundai and Kia, for example, have really kind of impressed a lot of people with their design, with the technology that they're coming out with, and the IONIQ 5 and the IONIQ 6, and then the Kiwi EV6. And now the upcoming EV9, it's a 3-row SUV. That's going to be enormously popular in the United States. We have lots of demand for big SUVs in this country. And I think that there's been a lack of larger electrified 3-row SUVs. And I think Kia could really capitalize on that. I think Tesla came out with the Model X much earlier, and there was a lot of problems with that vehicle. The Falcon wing doors were polarizing. You're talking about polarizing design with the Cybertruck. We should have seen the writing on the wall with the Falcon wing doors on the Model 6. There have been a lot of problems with those doors. Customers have reported a lot less satisfaction with how that vehicle turned out. And I think that there's still a big open market right there for 3-row SUVs in the electrified space. And I think in trucks also. I think if you have a truck that looks like a truck and not like the Cybertruck, you stand a pretty good chance in selling a lot of them. Truck buyers are very loyal. They're very brand loyal. So I think they're waiting a lot for that Ram truck to come out, maybe some from Jeep, for example. I think that those could really help spur a lot of interest in the EV space.
Indeed. A lot of people still wondering, if they do get a Cybertruck, where will they be able to get it fixed? I mean, this is a very, very unique car. So, a lot of things, and as well as sort of that vehicle, that driving range anxiety as well. Well, I'm sure we'll know more at 3 p.m. Eastern today. A big thank you to you both, RBC Capital Markets lead equity analyst, Global Autos Tom Narayan, and The Verge transportation editor Andrew Hawkins. Thank you to you both. All right, coming up, ease on down the road. The Fed's preferred inflation gauge, PCE, showed inflation continuing to ease in October. We talk what this means for the Fed policy next. We're watching oil this morning. Multiple sources are reporting that OPEC Plus members have agreed to cuts of at least 1 million barrels per day for early next year. Here with the details of this agreement is our very own Inez Ferrer. Hey, Inez.
Hey, Rochelle. Yeah. And so we saw oil earlier going higher when the announcement was made that OPEC Plus had agreed to an additional 1 million barrels a day of cuts. That's on top of the unilateral cuts from Saudi Arabia. But we're watching right now that oil prices are lower. We're going to pull up our Wi-Fi Interactive so you can see WTI is down more than 2%. You've got Brent crude that also has dropped recently. And why is this? Well, it turns out that we're still waiting for some of the details about these production cuts, but it could be a little bit of a repackaging of the same, meaning that it's looking like the additional 1 million barrels a day of cuts won't be formalized into a new official output target. Instead, what we're expecting is that member states will individually be announcing their contributions. So traders are looking at this like, it's maybe a little bit of the same. Look, before this announcement came out, there was an expectation in the markets that OPEC Plus would be rolling over its current cuts that it has this year into next year, and that Saudi Arabia could be extending its unilateral cuts of 1 million barrels a day. And so what traders were also expecting was perhaps a deepening of cuts. But so it looks like what is being announced, the details are going to determine a lot. But what we're looking at now is traders sort of reacting to, okay, this looks like it may be a little bit more of the same. You also have increased demand going into next year. Analysts have been talking about production increase in the US and Guyana and Brazil as well. And so they're talking about this being balancing between what you've got with supply and demand. Look, these OPEC cuts are expected to create a floor on prices because we have seen the outlook for demand weaken a little bit, and they are trying to create a pricing floor here, guys.
Yeah, and as you talk about a pricing floor, I mean, we have seen a steady decline in gas prices over the last 60 days or so. What are you hearing from analysts about how much further we're likely to see these prices fall, given some of the supply dynamics you just pointed to?
Yeah, well, those prices are supposed to fall into the end of this year, and then going into the spring, as you have an uptick in demand, you're expected to see prices increasing seasonally, as you would expect. If the oil prices that we're watching right now go up because of these production cuts, if we do see a supply squeeze of some kind, then you could feel a bit of a sting at the pump. KPMG's analyst just came out with a reaction to these production cuts, basically saying that production increases in the US and other places, that's going to soften the blow that's caused by these cuts. But that doesn't mean that consumers at the pump won't feel a sting should gasoline prices go up. But seasonally, they're expected to continue their downward trend, as we have been watching. You're looking at gasoline averages at $3.25 per gallon. But going into the spring, summer of next year, expect to see an uptick.
I'll certainly be tracking that. Appreciate you, as always, our very own Inez Ferrer.
Yeah.
Well, PCE showing little signs of price pressures cooling across the economy. For more on how economists are reacting to the fresh print and what it means for the Fed is Yahoo Finance's Jennifer Schonberger. So, Jennifer, we're continuing to see the numbers ticking down here.
That's right, Rochelle. The Fed's favored inflation gauge showing progress, with inflation continuing to cool, reinforcing Wall Street's expectations that the Federal Reserve will hold interest rates steady at its December policy meeting and is likely done raising rates. The Personal Consumption Expenditures Index, excluding volatile food and energy prices, clocked in as expected in October at 3.5%. That's down from 3.7% in September and down from more than 4% back in June. Quincy Crosby, chief global strategist for LPL Financial, says this morning's PCE print underscores that inflationary pressures continue to moderate to the downside. But the question remains if it will be enough for the Fed to declare a final victory. Now, EY senior economist Lydia Bassauer saying for the Fed, fresh signs of softer inflation and consumer demand confirm it is well positioned to remain on hold at the December policy meeting. We reiterate our long-standing view that the Fed's tightening cycle is likely complete. Now, Bassauer expects core PCE to fall to 2.5% in the spring and expects the Fed will start cutting rates in June. She anticipates a total of 75 basis points of rate cuts next year, with another 150 basis points in 2025. But she stressed that a faster economic slowdown amid lower inflation could prompt even more aggressive cuts next year. But Fed officials not ready to declare victory, even if Wall Street is. This morning, we heard from New York Fed President John Williams, who says that while he's encouraged by the progress in inflation coming down, inflation still remains too high, and that the Fed's job is, quote, not nearly done yet. He also emphasized that rates are going to need to remain high for some time. Meanwhile, we also heard from San Francisco Fed President Mary Daly, who says she's not even thinking about rate cuts now. Back to you.
Could be a long one here, Jen. Points to that continued divide among Fed officials. Jen Schonberger breaking that down for us. Thanks so much. Well, the Fed's favorite inflation gauge comes in line with expectations, with growth cooling to 3.5% year over year. It's a welcome sign for investors and the Fed, although still a ways away from the central bank's 2% target. So what could this fresh print tell us about the Fed's policy playbook heading into 2024? That's speaking of Greg Dacko, EY Chief Economist, and Youngyu Ma, BMO Wealth Management U.S. Chief Investment Officer. Good to have both of you on today. Greg, I'm going to start with you with that question that Jen just raised, which is this latest print enough for the Fed to say, yes, in fact, we do feel comfortable keeping rates where they are right now?
I think so. I think we're seeing increased evidence that the disinflationary process is well underway. We are in an environment where we're seeing gradually cooling final demand for goods and services. We still have more disinflation coming from the rent sector, and we have monetary policy that's restrictive. That's the ideal combo to continue pushing inflation lower. We've been saying for quite some time now that inflation would fall faster than the Fed has been anticipating. This is now materializing. So we're anticipating by early next year, we'll be close enough to the Fed's 2% target to start talking about rate cuts. And we think the first rate cuts will come in June. So yes, we are on this right trajectory.
And Youngyu Ma, I want to bring you in here because we've seen a lot of analysts agreeing that perhaps second half of 2024 is when we could see rate cuts, even though Fed speaks saying something slightly different. But you say the direction matters more than the timing. Break that down for us.
That's right. We do think the markets will key off of the Fed's main message that will evolve in 2024 to be a trajectory of rate cuts and a softening message before that. And whether or not there are 2 rate cuts, 3, 4, we think that's less important. And even the timing is somewhat less important if it takes place in May, June, or later in the summer. Really, the direction for the markets is what's going to be helpful and help to shift psychology and also help to lower borrowing costs in advance of those rate cuts. So we're pretty optimistic. We think that was a very nice print that we saw this morning. If you look at the month-over-month numbers, which we like to focus on for the trend, those look very attractive and sort of trending toward that 2% level, maybe not quite there, but at least trending in that direction. And we do think this gives the Fed some confidence to ease off of its messaging in December, but it's not going to pull back too far. It does want to still message that, you know, there's more data that needs to be seen, more confirmation. So we do think the Fed is going to temper the market's expectations a bit, but the trajectory is what matters the most.
Greg, where do Treasury yields factor into the Fed's decision making? You know, going into that last meeting, so much of it was about the rapid rise of those yields. We're still, you know, we're well off that talk about a 5% on the 10-year or the 30-year yield. But does the decline that we've seen since, does that complicate the decision making for Fed officials?
It might on the margin. I know there was a lot of discussion as to what had initially prompted the rise in the 10-year yield towards 5%. You know, the question of whether this was an implicit assumption that the Fed would have to do more tightening in order to bring down inflation, or whether this was an indication of the term premium being on the rise. I think what we're seeing right now in markets is essentially this expectation that the growth momentum is slowing, that the economy will advance at a slower pace, not a recessionary pace, but a slower pace into next year, that inflation is moving in the right direction. As we were just discussing, if you look at 3-month or 6-month annualized measures of core inflation, we're at 2.5%. So that's close enough to the Fed's target. That's what's being priced into markets. I don't necessarily fear that this easing of financial conditions is going to spur faster growth that would otherwise be inflationary. On the contrary, I think what we're seeing is a reflection of a slower environment where disinflation is continuing to progress at a fairly steady pace, and that we're moving in the right direction to allow the Fed to ease monetary policy gradually.
And Youngyu, as we await some of the lag from, you know, the Fed's medicine to really take hold in the economy, especially for consumers who are continuing to spend, despite what we've seen with credit card defaults and credit card debt continuing to climb, when will we actually get a sense of how U.S. households are doing and whether and how much of an effect the Fed's policy has had so far?
Well, I do think this holiday shopping season will get some sense of that. We do see signs of moderation, certainly in spending. But spending's holding up reasonably well, but there is a bit of a slowdown underway. We're seeing some strains, at least in certain segments of the consumer sector. But we do think it's a modest pace, a modest slowdown. It's not a collapse. It's not falling off a cliff. and it is somewhat controlled. So we think that data will evolve gradually, but we don't expect the slowdown in consumer spending to go too far. We think it will last for several months, but after that, we'll see stabilization as the environment starts to become more amenable to sort of softer interest rates, lower inflation, real wage growth continues to help to support spending. So we think factors are in place to achieve the soft landing.
Greg, certainly a lot of business leaders looking for some guidance in times of uncertainty. You've kind of laid that out in your latest newsletter. I mean, what are the key factors you think leaders should be looking to or need to know heading into 2024?
Well, I think one of the key advice for business leaders is really to look into scenario activity and essentially develop scenarios around any baseline, because we know that the consensus has a lot of variation in terms of the economic outlook going into next year. Some are forecasting steady growth around 2%. Some are forecasting a recession. We're currently pricing the odds of a recession around 50% because of this nuanced outlook. I think two factors will be key as we move into 2024. One, cost fatigue. We as economists, policymakers, academics talk about inflation. What matters for people, households, business leaders is the cost. And we're seeing cost fatigue in terms of goods, services, labor that is starting to affect business decisions, household decisions. The second factor is what happens to the labor market. Are we going to see a more pronounced pullback in the labor market? If we do, then that will lead to slower income growth and will further constrain consumers' ability to spend, to pay their debt. That would be a recipe for a slower economic trajectory. So those are the two key factors that we're paying attention to when it comes to 2024.
We'll certainly see if companies keeping that top of mind heading into the end of the year. Big thank you there to Greg Dacko, EY Chief Economist, and Youngyu Ma, BMO Wealth Management US Chief Investment Officer. Thank you to you both. All right, coming up, a rough ride for the real estate market. Pending home sales hit a record low in October. What that means for Americans' wallets. Next.
Pending home sales for the month of October are out this morning, dropping to the lowest level on record. Let's bring Yahoo Finance's Danny Romero to break down the numbers for us this morning. Danny.
Akiko, October was the worst month for buyer affordability. The 30-year fixed mortgage rate was hovering around 8%, sidelining buyers. Home sales under contracts dropped 1.5% to 71.2 0.4, the lowest reading the National Association of Realtors reported. And the results were better than what the street was expecting. Economists on the street were expecting a 2% decline. That didn't happen. But if we take a look at what happened regionally, the Northeast was the only region that really saw a gain of 2.7% in sales under contract. The West, the South, the Midwest saw pending home sales drop in that area. I also got some context of what was happening also regionally in those areas. There was a little bit of a slight uptick in inventory there too. The major headwind still, though, does remain the lack of inventory, which is pushing up home prices. The S&P CoreLogic Case-Shiller National Home Price Index, that gained 0.7% in September. So due to the lack of supply, especially in these regional markets, is turning a lot of buyers into the new home market where these buyers are able to find some price incentives, mortgage rate buy downs, which is really helping with the affordability issue.
And Danny, not only are purchasers struggling, but homeowners looking to sell also not seeing a lot of the benefits right now.
Yeah, Redfin found that 3% of sellers actually sold their home at a loss from August to October. And this is 2.4% higher than a year ago. And the median loss was about $40,000. And some of the cities that saw the biggest losses were, for example, San Francisco. 1 in 7 sellers lost over $120,000. There were some upside in some of the cities, Rhode Island, Anaheim, California, San Diego, Boston, Fort Lauderdale, Florida. They saw a little bit of that upside, not too much of a loss there. But even though this is happening, sellers are still have more skin in the game due to the lack of the inventory issue.
Indeed. That's interesting to see their sellers also, losing some profit on the end there as well. Danny Romero, appreciate that update. Thanks so much. Well, China's economy may have seen a brief rebound earlier this year, but now it's showing fresh signs of struggling as it handles slowing GDP growth, high youth unemployment, and a growing property sector crunch. The economic data has generally been soft over the past 6 months, weakness in manufacturing principal among them. Factory activity slid even further into contraction in November as foreign orders dried up. And China's real estate sector has been at the center of the storm as concerns swirl over the stability of the nation's property developers.
Well, much of the nation's wealth is tied up in property. House prices fell in 70 major cities in November, and sales were down 4% lower than in October. And China isn't getting much help from businesses overseas in what has typically been a boost for them. New orders at home and abroad declining as world economies struggle to fight inflation in their borders. The data from the survey suggests that China's economy will likely slow in this final quarter for 2023, and next year could be met with even more challenging situations. Rochelle, the question that we keep asking is how much of is this going to be stopped by government intervention? We're talking about incentives, and so much of the discussion has been about what happened back in 2008, where when there was a global financial crisis, China stepped in with really fueling growth through large amounts of debt. You could argue that's where the property bubble really started to form. And here we are today. So the question is China comfortable with a slower 5% growth, maybe sub 5%? Or will they do even more this time around to inject the economy with additional stimulus, given where things are?
I mean, it's true. When you look at the number of factors involved, whether it's property, factory activity, services sector as well, also weighing on consumer sentiment, you have to wonder at what point Beijing is going to step in and how much they're going to do to support it. Because we've been talking about this new era of Chinese growth. It's not going to be what we saw with a breakneck speed, always above 5% every year. This is a very different and maturing Chinese economy, but definitely some warning signs to look for here. And China has a dual circulation strategy. They want to rely more on domestic consumption, but then you're also seeing foreign orders drying up as well. So something of a balancing act here. This is not the Chinese economy of old. But I mean, long term, a lot of people still bullish on the Chinese consumer. But this is an interesting phase considering how a lot of people were relying on China to be the economy that really led that post-COVID growth. So some nuance here for sure.
Yeah, and I guess there is an argument to be made also for those who've been watching China closely that this was inevitable. Yes, there is the concern around the property market. That's still a significant concern, but China was not going to grow at double-digit growth for years. This is partly a maturing economy, and so we've seen that as well. But to your point, Xi Jinping sort of for years looking at whether, in fact, he is comfortable with more quality growth, which is what he has sort of talked about in the past this time around. So something we'll be watching closely. Well, coming up, COP28 kicking off in the United Arab Emirates today. I'm going to be speaking to the Bezos Earth Fund CEO from the conference on the ground there. Coming up. World and business leaders are gathering in Dubai today as the United Nations kicks off its annual climate change conference. COP28 comes at the end of what is expected to be the hottest year on record, with countries still well off track when it comes to meeting their goals to avert a climate catastrophe. Financing that clean energy transition sure to be a key topic as countries most affected by climate change call on the world's largest greenhouse gas emitters to pay up. Our next guest is leading an effort to accelerate some of that funding. Dr. Andrew Steer is the president and CEO of the Bezos Earth Fund, and he joins us from Dubai today. Andrew, it's good to talk to you. Thanks so much for joining us.
Well, thank you, Aki.
Certainly a lot of skepticism going into this particular COP, largely because it is one of the biggest oil producers that's actually hosting the conference. What are your expectations going into the next 2 weeks?
Well, look, this is a very, very important set of negotiations and set of deal makings, really. This is the first time in history that the world has taken stock of where they are in terms of their commitments. And the so-called stock take came out in September. It's a very gloomy picture. As you said, we're way off track. And so things are very, very worrying. And of course, there's lots of political noise always around a COP. But once you get going, it's surprising what can happen. And, you know, there's sort of two strands. There's sort of what are the negotiators doing? And then what's actually going on outside? What are the big initiatives that are being supported? And so we're involved in both.
Climate financing is certainly going to be a big focus. It has been a focus for some time. The question being, if it is the most developed countries that have been responsible for climate change, why is it that the most developing countries are the ones that are having to pay up for this transition? What has actually shifted in this conversation since the last COP?
Well, look, it's obvious that since way back at the famous Copenhagen COP, way back in 2000 and what was it, 9, the rich countries promised to provide $100 billion a year from 2020 onwards. Looks like that's now being delivered. Not entirely clear, but actually that's not the point. 100 billion is nowhere near enough. We need over $4 trillion in order to get the transition going. That's a tripling of what we have now. And for middle income and lower income countries, if you exclude China, which is a case by itself, the expenditures need to increase sevenfold on green investments by 2030. So there's a massive problem. And of course, at the same time, interest rates haven't come down the extent that had been hoped for. Public purses are much thinner in both rich countries and in poor countries. Indebtedness is rising. So it is a difficult time. And that's why we've got to think of really innovative approaches, including carbon market money, but also other really interesting initiatives will be floated in the next 2 weeks here.
You've been working closely with the Rockefeller Foundation, with the State Department to set up what you've described as this Energy Transition Accelerator, ETA. Talk me through how this is going to help get some of that funding off the ground for these projects you've highlighted.
Well, at the moment, there's a lot of private money that would be willing to come in to invest in renewable energy or even decarbonizing existing energy systems, investing in utility and grids and so on. But actually, some of these environments are quite risky and some of the things are not quite profitable enough. And if you've got a country like Vietnam that's switching away from coal towards, let's say, offshore wind, that actually is more expensive. And so what we need to do is find some sort of grant or subsidized money that will take the first loss, for example. And so that's in a way what we're looking at. And we've come to the conclusion that actually carbon markets can play a very important role. If you take the so-called the just energy transition packages, which are packages that the G7 has done for South Africa, Indonesia, Vietnam, and doing for some other ones, essentially they've committed financial resources to those countries, and the deal is those countries will move towards much cleaner energy. The problem is that the commitments that G7 countries make on behalf of their private sector and on behalf of their own governments, it's actually very hard to find that money coming through, quite frankly, now, given how tight things are. And so what we're trying to do is to mobilize carbon market money that would come from Western and host country corporations who already are decarbonizing their own systems internally, but they want to go further. They want to, for example, decarbonize their scope 3, which is their entire supply chain. They want to be accountable for that. So they're willing to put money into carbon markets. And so what we're going to do is try and bring that money to the energy systems. And we actually see several $1 billion potentially on the table for that. And so what we're going to be doing is together with some host countries that will be announced on Sunday, together with some corporations that are willing to come in, and also very importantly, together with the standard setting organizations that are setting the rules of carbon markets, both on the supply and the demand side.
Policymakers have always been at the table at these conferences, but increasingly we have seen the private sector business leaders coming in. Is the interest still there? When you think about some of the biggest companies who have made these set these goals for net zero, I mean, do they still see the opportunity in climate investing, climate financing? What are you seeing in your conversations, or what are you hearing in your conversations?
Well, you know, there's always ups and downs in this. There was a time like 2 years ago when companies really got on fire on the notion of committing to net zero. And that's when the Global Financial Alliance was created, is where several thousand companies are committed to net zero, to science-based targets. Most of those are going well. And quite honestly, without the corporate sector, without the private financial sector, we would not be anywhere close to where we are. We probably wouldn't have had a Paris deal, actually. We certainly wouldn't have had the successful Glasgow meeting 2 years ago. However, having said that, It is absolutely true that, that having made a commitment, a well-intentioned commitment, some companies are actually finding it's harder than we thought. And that's entirely legitimate because it is difficult. And so we're now in a sort of a much more realistic, it's not Friday night, it's Tuesday morning, and actually it's hard. There's grind to be done. But the really exciting thing is that actually they're going forward, most of them. Not all. You've obviously seen a lot of criticisms of greenwash. You've seen, a certain, conservative politicians saying all of this is woke capitalism in the United States. Well, it isn't. It's actually the future of the world. So to call it woke capitalism is just plain nuts. It's tomorrow's economics. It's a much better world. And actually to see these CEOs coming to the table, I mean, there will be, I'm sure there's well over 1,000 of them here in Dubai. I don't know that, but I'll bet that is the case. Working very, very hard, very committed. So I take my hat off to them. It is not easy, and not all of them are serious, and there is greenwashing. But without these private investors taking things seriously, we would not be able to succeed.
Our thanks to Andrew Steer, their Bezos Earth Fund CEO and president, joining us from Dubai. Well, coming up, we're switching gears a bit. Beyonce taking the big screen. We're going to talk Queen Bee's Renaissance concert movie on the other side. We'll be right back. Activist investor Nelson Peltz and his firm Trian Partners are seeking multiple board seats and taking their case directly to shareholders. For more on that, let's bring in Yahoo Finance's very own Ali Canal, who's been following this for us. Ali, we've got a proxy fight on our hands.
Oh, yes, we do. And Nelson Peltz's Trian Fund confirming in a statement earlier today that Disney rejected its request to seek multiple board seats, including one for Nelson Peltz himself. In that statement, Trian focused in on Disney's struggling stock price, saying shares have underperformed both peers along with the broader market. Shares are down nearly 20% since Peltz ended his previous previous proxy battle in February. Now, this news does come just one day after Disney announced in an SEC filing that James Gorman, chairman and CEO of Morgan Stanley, along with Jeremy Derrick, former head of British television company Sky, will join its board early next year. But Tryon said that's not an improvement from the status quo. The addition of these directors will not, in our view, restore investor confidence or address the root cause behind the significant value destruction and missteps that this board has overseen. Tryon intends to take our case for change directly to shareholders. Now, Disney did respond in a statement of its own, saying the company has made many changes over the past year, like increasing its cost-cutting goal, improving profitability on the streaming side, and building out ESPN. The company saying in part, quote, "The Walt Disney Company has a proven track record of delivering long-term value to our shareholders and is in the midst of a significant transformation to reinforce our position as the world's preeminent entertainment company." So Disney really doubling down there that they are in a position to generate shareholder value. They have confidence in their current board, and they also brought up the relationship between Peltz and Ike Perlmutter, who was fired as Marvel chairman at Disney last year. Remember that Peltz has beneficial ownership of Perlmutter shares, which Disney did suggest could complicate a seat for Peltz on that board. Disney saying Perlmutter has a, quote, "long-standing personal agenda against CEO Bob Iger," which may be different than other shareholders. So clearly the battle continues to heat up here, and yet another headache for Bob Iger to contend with moving forward.
Indeed, it depends on how much patience investors have long-term versus what they're seeing with some of this tumultuous activity right now. Well, shifting gears, all the single ladies will be piling into theaters this weekend as Queen Bee hits the big screen. Beyonce's Renaissance concert film debuts tomorrow and is expected to rake in between $17 million to $20 million in its opening weekend. So, Ali, can we expect it to come up on top, or will it break your soul?
Well, the expectation is there, considering how well Taylor Swift's The Eras Tour movie did. That debuted to $100 million domestically earlier this week. It crossed the coveted $250 million mark globally. So that's certainly encouraging for a film like Beyonce, a name like Beyonce. I think we're going to see a lot of people come out in the theaters. This is another film that will be distributed by AMC. So the expectations are high. It really helps fill out the theatrical release slate, especially as the writers and actors strike, which recently concluded, really hindered some of those movie debuts this year. But we'll have to see. I'm excited for it. And Rochelle, I know you said you were going to see it as well, so I think it's going to be a good one.
Absolutely, I'm going to see
Rochelle
it.
went to the concert.
Yes.
And she's going to go see she's going to go see the movie. I will also be watching since I didn't make it to the concert. Certainly going to be a good one. Yahoo Finance reporter Ali Cannell there with the breakdown on Beyonce. That's it for now, for our show at least. I'm Akiko Fujita along with Rochelle Akufo. Keep it right here on Yahoo Finance. Much more to come.